Day Trading Strategies, a comprehensive beginner's guide for basic and advanced traders for achieving excellent results and becoming successful with a positive ROI in just 17 days. Written by Mick Brewer. Published by Audiobook Nexus.
Day Trading Strategies, a comprehensive beginner's guide for basic and advanced traders for achieving excellent results and becoming successful with a positive ROI in just 17 days. 2022. Mick Brewer. Introduction. Day trading gained popularity in the late 1990s during the dot-com bubble. During those days, it was simple for day traders to book profits. No skill was required. The stock market used to have such big moments that it became simple to buy and sell internet stocks and make huge profits daily. That was a brief but exciting and profitable period for day traders who traded tech company stocks and made a lot of money. NASDAQ. The tech index was skyrocketing at the time, rising by thousands of points in a matter of months. Day trading was a booming business because it was a massive wave in the tech ocean, and traders were riding it. Day trading became less profitable after the dot-com bubble burst and markets returned to their normal trading pattern. However, for many people, it remained a lucrative career. Online trading expanded rapidly during the dot-com era. This made day trading accessible to the general public. It made people realize that day trading, like other professions, can be successful by mastering the necessary knowledge and skill set. Stocks, or any other financial entity, are bought and sold throughout the day in day trading. To do so, they must be familiar with a variety of skills and tools, as well as understand when to buy and sell stocks. Large financial firms sprung up overnight and began day trading on behalf of their clients. Banking institutions began opening securities branches for the general public where they trained their clients to become skilled traders. Since then, the popularity of day trading as an income-generating vocation has grown. Here are a few things you will need to learn if you want to be a successful day trader. Knowledge of the stock market. As a day trader, you should have a basic understanding of stock markets. You should be aware of which stocks or companies are popular on the stock exchange. They will trade with more volume, and volume is important in day trading. Technical analysis fundamentals. Unlike fundamental analysis, the technical analysis predicts how the price will move in a shorter time frame, which is critical for day traders. So, if you want to make day trading your career, this is a skill set you must have. There are numerous online courses available for technical analysis and chart reading. Offline workshops are also held by various institutions to teach this. You can enroll in any of them to learn how to analyze charts and what tools to use for day trading. Money management abilities. Stock trading does not allow you to spend an unlimited amount of money. Before you begin, you must set aside a specific amount of money for your trading business and carefully manage that money. You should always be aware of your losses and profits so that you can determine whether your trading business is succeeding or failing miserably. There are numerous books available online about money management in day trading. Reading a few well-known ones will give you a good idea of how to manage your risk-reward ratio. Find out more about trading psychology. Emotions are detrimental to day trading, and you must be aware of how to manage your emotions while trading. Many successful day traders have written trading psychology books. It's a good idea to read a few of them before trading. Emotion cannot sustain a business, and before you enter the trading arena, you must be able to control your emotions, whether you make profits or losses. What makes a day trader unique? Technical traders are day traders. They execute trades based solely on chart readings, ignoring factors such as the company's profitability, PE ratio, debt-to-equity ratio, and so on. Technical charts are the only tools a day trader has for making money. Day traders typically trade in a single session and close all open trades at the end of the day, leaving no position open for the next day. Swing traders are traders who hold their position open for the next session or overnight. A day trader can trade using a variety of time frames on technical charts. These time frames can range from 1 minute or less to 5 minutes, 15 minutes, 30 minutes, 45 minutes, 1 hour, 4 hours, and even weekly and monthly. If you're wondering how a day trader can use weekly or monthly charts, you should understand the difference between time frames. Day traders choose their trading style by examining the charts and determining which time frame is best for them. Every day, many day traders can spend hours in front of their computer screens. However, many day traders trade only part-time, are preoccupied with other jobs or work, and cannot devote much time to trading every day. In such cases, these traders can examine weekly or monthly charts to determine when to buy or sell a stock. They then patiently wait for that level to arrive and trade only at that level. There are numerous ways to set an alert to notify you when a price level has been reached. The brokerage platforms provide SMS alerts to their clients about stock prices. Most charting software includes the ability to send alerts when a stock price level is reached. They save valuable time and money by trading in this manner, which they can use to pursue other money-making activities such as a regular job or doing other work. There's one more. Scalping is a highly skilled type of day trading. Because the day trader focuses on a short time frame, such as 1 minute or a few seconds, and trades for small profits, this is also known as micro trading. They keep the lot sizes large so that small profits can compound into large sums of money. Because the time frame is so short, scalpers can trade multiple times throughout the day, sometimes as many as 20 to 50 times. However, this is a risky type of trading that necessitates extremely fine trading skills. Otherwise, it is possible to lose all of one's trading money in a single session. Buying and selling on the same day is also referred to as day trading. Day traders, on the other hand, have a longer time frame for keeping their positions open than scalpers. This can take anywhere from a few minutes to several hours. The internet is rife with articles that show glamorous images of day trading, leading you to believe that you can get rich quickly using this trading method. However, this trading method necessitates hard work, knowledge, razor-sharp focus, and extreme patience, not to mention a large sum of money to invest in the early stages. When day trading, you must be completely focused. You must not allow yourself to be distracted by other things. If you can afford to have this level of discipline and dedication, you will find that day trading is a good fit for you. Day trading is also known as intraday trading. This term provides a more precise definition of a day trader because it indicates that buying and selling occur within a single day. Day traders can branch out into other types of trading, such as momentum trading, positional trading, swing trading, and long-term trading. All of these trading styles are specializations, but they do not usually fall under the day trading category. Chapter 1. How day trading works. There was a time when the only people who could trade in financial markets were those who worked for brokerage firms, trading houses, and financial institutions. However, the rise of the internet made it easier for individual traders to get in on the action. Day trading, in particular, can be a very profitable career path if approached correctly. However, it can be difficult for new traders, particularly those who lack a good strategy. Furthermore, even the most seasoned day traders experience adversity from time to time. Day trading, as previously stated, is the purchase and sale of an asset within a single trading day. It can happen in any market, but it happens more frequently in the stock and forex markets. To profit from small price movements in highly liquid currencies or stocks, day traders employ short-term trading strategies and a high level of leverage. Day traders with experience keep an eye on events that cause short-term price movements, such as news, corporate earnings, economic statistics, and interest rates, which are influenced by market psychology and market expectations. When the market outperforms or underperforms those expectations, it causes unexpected significant moves that can benefit astute day traders. However, Entering this line of business should not be taken lightly by a prospective day trader. Day traders can make a comfortable living by trading for a few hours each day. This type of success, however, takes time for new traders. Consider several months or more than a year. For most day traders, the first year is extremely difficult. It is full of numerous wins and losses that can test anyone's nerves to the breaking point. As a result, a day trader's first realistic goal should be to keep his or her trading capital. When it comes to day trading, volatility is the name of the game. To make money, traders rely on the fluctuations of a market or stock. They prefer stocks that fluctuate several times per day, but are unconcerned about the reasons for those price fluctuations. Day traders will also seek out stocks with high liquidity, as this will allow them to enter and exit positions without affecting the stock's price. Day traders may short sell a stock if its price is falling or buy it if it is rising. Depending on market sentiment, they may trade it several times in a day, purchasing and short selling it several times. Regardless of the trading strategy employed, their desire is for the stock price to move. Day trading, on the other hand, is difficult for two reasons. Day traders, for one thing, frequently compete with professionals, and for another, they have psychological biases that complicate the trading process. Professional day traders are familiar with the traps and tricks of this type of trading. Furthermore, they succeed by leveraging personal connections, trading data subscriptions, and cutting-edge technology. Nonetheless, they continue to make losing trades. Some of these professionals are high-frequency traders, whose goal is to profit from every trade. Because the day trading field is a crowded playground, professional day traders welcome the participation of inexperienced traders. Essentially, it allows them to earn more money. Furthermore, retail traders tend to hold on to losing trades for too long and sell winning trades too soon. Because of the desire to close a profitable trade to make money, retail investors tend to pick the flowers while watering the weeds. In other words, they have a strong aversion to even minor losses. When it comes to purchasing a declining asset, this tends to tie their hands behind their backs. This is due to the fear that it will continue to fall. How to begin? People who want to get into day trading should do several things to get started. First, they must take a step back and consider whether this type of trading is truly for them. It is not for the faint of heart to engage in day trading. It necessitates a high level of concentration and should not be attempted at the expense of one's retirement savings. Actually, before committing their hard-earned money, beginners should consider opening a practice account. Aspiring traders can use such accounts or stock market simulators provided by reputable brokerage firms to make hypothetical trades and see the results. In addition, before they begin trading, aspiring day traders must have a suitable brokerage account. Some brokers charge exorbitant transaction fees, which can eat into the profits from winning trades. Furthermore, good brokers provide traders with invaluable research resources. Aspiring traders who discover that day trading is not for them should do what smart investors do. Invest in a diversified fund or stock portfolio over the long term. They should add more funds to their accounts regularly and let the magic of growth expand their investment portfolio. This may not be as exciting as day trading, but it is preferable to doing something that will deplete one's savings. Consider the constraints and objectives. Prospective day traders should consider their constraints and goals before investing time, energy, and effort in learning, or creating and then practicing day trading. As an example, traders must determine whether they have sufficient capital to engage in day trading. If they lack capital, they should wait until they have it before learning and practicing various trading strategies. They should understand that achieving consistent gains can take several months to a year, even if they practice for several hours every day. Those who practice infrequently will take longer to achieve success. Therefore, prospective traders should invest the time and effort necessary to achieve their objectives. Once they begin trading, they must commit to trading for at least 2 hours per day, depending on their other obligations. New day traders should not quit their day jobs until their trading profits match or exceed their income. They must also determine the best time of day to trade based on their other obligations. Furthermore, they must ensure that their trading strategy is appropriate for the time of day. Essentially, their trading strategy must be tailored to their lifestyle. People who want to get into day trading must first decide whether they want to do so to quit their regular jobs. Prospective traders must understand that they will most likely need to practice and trade for a year or more, depending on their dedication, before they can replace their day jobs through day trading. Before investing their time and money in learning this trade, aspiring day traders should consider the factors listed above. Select a broker. While new traders are practicing and developing their trading strategies, they should take the time to select a reputable broker. It could be the same broker with whom they opened a demo or practice account, or it could be a different broker. Choosing the right broker is one of the most important decisions that day traders will make because they will entrust the broker with all of their capital. Capital required to begin day trading. How much money do people need to get started? Day trading is determined by the market in which they trade, the location in which they trade, and the trading style they prefer. There is a legal minimum capital requirement set by the stock market in today's trade. However, there is also a recommended minimum based on the individual trading style. A day trader must have enough capital to be able to make a variety of trades while also surviving a losing streak, which is unavoidable. Traders must also determine the amount of money they require, which necessitates risk management. Furthermore, they should not risk more than 2% of their account on a single trade. When it comes to day trading, capital is the most important factor. By putting only 1% or 2% at risk, even a long losing streak will leave the majority of the capital intact. In the United States, the legal minimum balance required to day trade stocks is $25,000. Traders whose balance falls below this amount are unable to day trade until they make a deposit that raises their balance above $25,000. Day traders in the United States should have at least $30,000 in their trading accounts as a buffer. Stocks typically move in 1-cent increments and trade in lots of 100 shares. Therefore, day traders will have some flexibility if they have at least $30,000 in their accounts. Day traders can typically obtain leverage of up to 4 times their capital. For example, a trader with $30,000 in his or her account can trade up to $120,000 in stock at any given time. In essence, the trade price multiplied by the position size can exceed the trader's account balance. Day traders can trade less volatile stocks, which often necessitate a larger position size and a smaller stop loss, or more volatile stocks, which necessitate a smaller position size and a larger stop loss. In either case, the total risk on each trade should not exceed 2% of the trading account balance. Chapter 2. Is day trading right for you? Yes. No. Maybe. Now that you have a basic understanding of what day trading is and how day traders spend their days, you can begin to consider whether day trading is right for you. There are emotional considerations, time commitments, financial availability, and, of course, the question of whether you can work alone. There is also the issue of your other responsibilities, if you have a backup plan, as well as what to do when the day trading world is particularly difficult to navigate. Temperament and emotions. The first thing you should consider is the job's emotions. To perform the job effectively, all jobs require a certain level of emotional commitment. The effect of having your income tied to the uncontrollable ups and downs of the market can cause emotional mania and depression. When you are trading the market and have a profitable day, you may feel as if you are floating in a euphoric state where nothing can affect you. This is a very positive emotion to feel, but as the markets reverse and your trading account shows losses, you may feel the opposite. During these times, your emotions may be as low as the market. This unmanaged emotional up and down of the market can become a thrill ride in and of itself, with you always on the lookout for the next wild swing of emotions. With this in mind, it is critical to learn how to step back and view trading as a job, with your trading account serving as your tool. When a customer brought in a Ferrari to be worked on, the mechanic would be excited, but he would approach the tune-up, carburetor adjustment, and engine rebuild with a cool, professional separateness from his love of Italian cars. He would never mistreat his wrenches or gauges in a way that would diminish their value or harm them in any way. This is an excellent way to begin thinking about trading in your trading account. You will be working on very expensive, exotic things while using your valuable trade tools. You will trade a specific sector with your valuable trading account. One of the most important aspects of a long-term successful day trading career is trading as a professional or treating trading as a business. Before you make a trade, your emotions can be attached to it. You can learn to use a cool head to plan entry points, the point at which you make your initial purchase of a stock, commodity, or currency, as well as to use calm, calculated feelings to exit a trade to capture profits. Numerous stories of day traders are overjoyed with their unrealized gains on a trade. Unrealized means the profits are still on paper and not yet in the day trader's account, as the trade has not yet been closed out, but are unable to exit the trade in the hopes of making more gains. The trade suffers as a result of these stories, and profits are lost. These traders then tell stories about how they should have taken the profits and what was I thinking? If you can learn to manage your trading emotions, you will be well on your way to making money on good trading days and keeping your money on bad trading days. Good emotion management is essential in day trading for good money management. Commitment of time. The second factor to consider before embarking on a day trading career is your ability to make a time commitment. Depending on where you are in your overall market knowledge, it can take anywhere from a month to several seasons to gain enough general knowledge to start trading successfully. To become acquainted with the markets, you must commit to a somewhat structured study period of at least a few weeks by reading books and magazines designed for independent day traders, as well as skimming through daily business newspapers such as the Wall Street Journal and the Financial Times. People frequently want to start placing trades and profiting right away. If you want to be as successful as possible, it is best if you take your time learning the markets before investing any money. There have been reports of people opening accounts online in a matter of minutes, depositing funds, and rushing to trade. There have also been reports of day traders placing trades in new accounts, despite not knowing how to use the trade input screens. They then executed trades in the opposite direction and for the incorrect amount. Such disasters can be avoided by taking your time when opening an account, learning how to use it, and researching the products you want to trade. Trading also takes time once you're up and running, as it takes time to sit in front of your computer and capture the gains of the market as it moves up and down. While some markets are open late into the evenings and overnight, the majority are only open in the mornings and early afternoons. This means that to day trade, you must be available during these hours to follow the news, read charts, and place trades. However, it is possible to trade on a part-time basis. Some trades can be completed on Sunday afternoons and after work on weekdays. If you want to start your day trading on a part-time basis, this is a good option for you. Allow yourself enough time to learn the market despite your rushed schedule. Tolerance for risk. Before you begin a day trading career, you should consider how much risk you are willing to take on. Not only is there risk associated with the market's ups and downs and the possibility of your fortune's ups and downs, but there is also the risk associated with opportunity risk. This opportunity risk comes in the form of the possibility that you are a full-time day trader, passing up the opportunity to earn a steady, relatively risk-free paycheck from working at your regular job. By definition, day trading entails some risk. You are putting your money at risk to make a living. That's all there is to it. Some jobs put your money at very little risk while you're working for a living. This is not the case when it comes to day trading. You may face the possibility of not earning a living while working at your safe, steady job. You must understand that you must put up your capital, your money. To make more money, you will be putting yourself at risk to gain reward in the form of profits. Risk, it is said, leads to reward. This means that the greater your risk, the greater your potential reward. The key word here is possibility of reward. Before you start day trading, you should be aware of your risk tolerance. You should reassess your risk tolerance before each trading day and trade. Your goal should be to risk as little as possible while gaining as much as possible. Each trade should be set up with the expectation that it will fail. You should calculate how much you could lose on the trade ahead of time. The worst case scenario. Keep in mind that you are trading money that could be put to better use than this trade. Risk, like emotions, can be managed. Risk management is a science that involves trade size, money management, and market knowledge. While day trading, it is possible to make extremely risky trades. It is also possible to hedge all of your risks, which means that you are taking measures that result in very little risk during a trade, as well as the possibility of earning very little profit. As a day trader, you must learn to use a little math, market knowledge, and common sense to strike a happy, profitable balance between the two. Funds available. When doing work, some kind of equipment is usually required. If you are a plumber, you may require a van to transport your plumbing equipment. Brushes and ladders may be required if you are a painter. Accountants may require computers, adding machines, and tax software. When you are a day trader, your trading account is your equipment. Typically, your trading account is funded with a combination of cash and margin. Just as a plumber requires a specific size van, you will require a specific amount of money today to trade with. For starters, it doesn't have to be much. With as little as $250 in your account, you can have a lot of fun and learn a lot. If you have $250 in your foreign exchange trading account, for example, you could spend the night making small, quick trades while watching TV. It is possible to do this every night and make enough money to pay for your breakfast donut, lunch, and afternoon coffee, all on the profits from the previous night. This can be an excellent way to become acquainted with market jargon, software, and the order entry process, all while developing a positive trading experience. Beginning to learn how to trade with smaller amounts can be a very rewarding experience. It takes a lot of confidence and willpower to place trades large enough to earn a living. You can gradually add to your account and trade larger and larger amounts if you start small and get used to the feeling of winning a trade you planned. You will, however, need to set aside enough money from your regular household budget to trade with. It is not a good idea to trade your rent or car payment money. You should trade with money that has been designated for your trading account, i.e., money that you are willing to lose or use for a risky venture such as day trading. After you've established yourself as a full-time professional day trader, you'll be able to withdraw funds from your account on a bi-weekly or monthly basis as a salary draw. Until then, you should allow the money you trade with to grow with each winning trade. Can you work by yourself? After you've determined that you can control your emotions, understand your risk tolerance, and have disposable cash to trade with, the question of whether you can work alone remains. Day trading is frequently done alone. Day traders frequently trade from their homes, away from the business and financial districts of their hometowns or neighboring cities. You may find yourself missing the interaction of your coworkers, friendly chats with other commuters on the train to work, or even the act of walking down to the corner coffee shop with an office friend for a much-needed afternoon break. You will essentially be working alone the entire time. Not only will you be unable to speak with coworkers about last night's game, but you will also be unable to discuss your trading ideas with an office mate. You might even find yourself wishing you could approach a manager or boss about a trade you're about to make that involves more than your usual amount of money. In these situations, having a superior shoulder the burden of your decisions may be reassuring. In day trading, this is not the case. all of the money, knowledge, skill, and risk-taking are yours and yours alone. Chapter 3. Risk and Account Management. Both account and risk management exercises occur concurrently as you progress through the day trading investment cycle. You must achieve your goals of making significant profits while also mitigating losses from the capital in which you have invested. Your risk management strategies, on the other hand, entail responding appropriately to mitigate potential losses in an uncertain future and limiting your exposure to financial risks. Employ a stockbroker. As a beginner or new investor, participating in day trading can be difficult if you go it alone. To keep track of your capital progress, you need advice on the best stock opportunities to invest in, guidelines on how to handle potential financial risk exposures, and knowledge of technical analysis. These financial services are typically provided by a qualified and registered stockbroker for a commission or flat fee. Account management and risk management are strategies that a stockbroker is born with, especially when given access to an account. Furthermore, it is common for your stockbroker to have extensive experience managing financial risks. The tools used for technical analyses have the same levels of complication and sophistication. You must use these analytic tools to make informed decisions based on their data. At this point, a stockbroker can help with data interpretation that you were previously unaware of. Account and risk management in day trading is frequently all about making the right decisions based on technical analysis. Create a trading strategy. This document is an essential resource for you as a new day trading investor. If you do not have such a program, it may be time to create one that is tailored to your specific trading needs. Furthermore, the program should include tactical or short-term goals that are set at regular intervals throughout the cycle. Once you've finished creating a trading plan, you must follow its guidelines at all times. Keep things simple. In day trading, you may mistakenly believe that you must overextend yourself on high-risk investments to make a substantial return. You must learn how to make small trades on stocks that are at the low-risk end of the trading spectrum. In the event that a specific trade deal goes bad, you must resist the urge to make irrational trading decisions to make up for your previous loss. Furthermore, keep an eye out for volatile stocks and try to avoid trading in them as much as possible. As a result, you will avoid the massive losses associated with complicated, high-risk trading that is highly emotional. Determine a stop-loss level. You can issue orders that reverse potentially harmful financial positions to manage the amount of risk you are willing to expose your trading portfolio to. This order instructs your stockbroker to immediately halt all day trading activities. The order specifies the specific stock price above which you cannot risk purchasing or offloading because doing so would result in a clear financial loss. Putting yourself in a losing situation is an irresponsible move on your part. Furthermore, close monitoring of the fluctuating price of your specific stock is required to ensure the successful execution of the order when required. Determine the size of your position. Position sizing entails determining the amount of capital with which you intend to participate in particular day trade. As a result, determining your trading position early on is critical before engaging in any type of transaction. The number of shares of stock you acquire on a particular trade divides your position size into an account and trade risk. You must set a limit on the amount of capital to trade in each deal or transaction to minimize any potential financial downfall caused by the degree of your account risk. Consistency is essential when establishing these account restrictions. Don't keep changing the allocated portion for different trading transactions. You should choose one value and apply it to all of your day trading transactions. Aside from the risks to your trading account, the other financial exposure from position sizing is the trade risk. The difference between the entry point for your day trading and the specific numerical amount set as the order limit constitutes your trade risk. As a result, you should place stop-loss orders close to your trading entry point to reduce the possibility of potential losses spiraling out of control. When setting the restriction value on a stop-loss order, keep some wiggle room in mind. Account risk/trade risk equals the optimal number of shares required position size. Control your emotions. If you are not careful, emotional influence on day trading practices can quickly become counterproductive. You should be aware that when you are on a winning streak, you are more likely to develop a false sense of overconfidence. The fear of experiencing losses is another emotional input of concern. Losses are unavoidable in day trading, and you must learn how to recover after a particularly bad run of consecutive losses. If you do not have a coping mechanism for potential losses, you may experience crippling fear, rendering you unable to continue trading. Fear is also to blame for holding onto a stock position for too long. Instead of selling your shares at a reasonable profit, you may decide to wait for much higher prices, which may result in a loss if the stock price trend reverses. Even in these trying times, you must stick to your trading plan's guidelines and instructions. Remember that, to ensure responsible capital management, you must begin making decisions based on logic. Managing your account and the risks associated with day trading entails managing the available equity in your brokerage account responsibly. Account management can be accomplished by increasing your investment in profitable stocks, ingenious trade maneuverability, or exiting stagnant trade deals. Some of the primary strategies you can use in your day trading to ensure active risk and account management are as follows. You must seek the assistance of such stockbrokers to benefit from their experience and expertise in day trading. Furthermore, using the services of a stockbroker increases your chances of achieving your profit objectives. As a result, you must open a brokerage account through which you will conduct all of your day trading activities. Maintaining liquidity in this account is just as important as making the right trades, because you may not be involved in the stock market all of the time. Managing your trading account is the responsibility of your stockbroker. You must give him or her the freedom to make informed decisions on long and short trades, no matter how risky they appear at first. Trust your broker to understand what he or she is doing with your account, which is why you should hire a trustworthy stockbroker, preferably from a well-known brokerage firm. Most strategies for combating potential financial threats, such as spreads, are difficult to understand, let alone apply effectively. You will also learn about various management strategies. Creating a trading plan is a task that you must complete with the assistance of your stockbroker. Because the broker typically has experience in the day trading sector, he or she can advise you on trading opportunities that have the potential to be profitable. Based on this critical tip, you can create a comprehensive trading plan with a clearly defined overall goal. The primary goal of these operational targets is to allow you to track the progress of your day trading activities. Day trading requires both you and your broker to have a chance at success. As a result, you must both follow the trading plan's rules. It outlines how you should react and what steps you should take with your capital in various situations. Because the future of day trading is frequently uncertain, it is critical that your plan include emergency financial responses. If you stick to your trading plan, your chances of making a profit will increase significantly over time. You will also have an intervention policy in place for potentially risky financial exposures. This is a dangerous mindset to have when starting in day trading. Keep in mind that underlying stocks are frequently a more volatile type of security than other investments. Fluctuations in the value of the traded stock are common and usually occur over a short period. Be wary of succumbing to the desire to take a chance on riskier stocks. Greed and emotional influence are the primary motivators behind such irresponsible trading practices. If at all possible, keep such stocks out of your portfolio. As a result of the high levels of financial risk associated with highly fluctuating stocks, request that your broker sell them completely. All of these blunders are easily avoidable if you follow the simple trading practices outlined in your trading plan. Proper and responsible account management necessitates the avoidance of rash decisions that may result in potential losses and the loss of potential profits. Risk management also looks after itself by limiting your exposure to the high-risk end of the trading spectrum and staying away from volatile stocks. A stop-loss order restricts the amount of stock price movement you can tolerate without incurring a significant financial loss. It enables him or her to immediately stop buying or selling any additional stocks based on the unfavorable prices. You will eventually end up with a depleted brokerage account as a result of mismanagement of your previously available capital. Stop-loss orders are especially useful when trading volatile stocks on the same day. Set the stop-loss order to a value that is as close to your trading entry point as possible. As you can see, when used on volatile stocks in this manner, stop-loss orders act as risk management tools, mitigating the financial downside associated with rapidly fluctuating stocks. The size of your investment is directly proportional to your risk tolerance. A large number of trades will invariably expose you to more financial risks than a small number of trades. High-risk transactions and day trading practices frequently put your brokerage account in jeopardy. The possibility of running out of available capital in your trading account increases. For this account limit, a fixed ratio or a small percentage is frequently recommended. A better limit would be 1% of your available capital balance or less. Make sure to stick to the simple strategy by allocating only small amounts of capital to low-risk stocks. Stop-loss orders are the most effective way to mitigate trade risk. As previously stated, this order allows you or your stockbroker to exit a trade deal if the set loss limit is reached. This action limits further capital loss. Thus, it contributes to financial risk management in this way. Make sure it's not too tight that it interferes with your ability to trade. Account and risk management are both responsible for position sizing. The evasive maneuvers described here usually help to reduce risk. You need this wiggle room to give your stocks a chance to rise in value without being stymied by a stop-loss order. Such moves allow you to keep your trading account in good shape. As previously stated, the number of shares required for a potentially profitable trade is proportional to your ideal position size. As illustrated below, the primary emotions to be on the lookout for are self-assurance and fear. Excessive confidence in your trading abilities can lead to a false sense of self-belief. As a result, you may end up making illogical trading decisions and choices based on your arrogance. The successive trade deals that come to fruition give you an air of self-belief that could be abused. You gain confidence in your trading abilities and dare to engage in more risky transactions. You will face a massive financial disaster at this point, especially if you overextend yourself financially. Be wary of situations that appear to be too good to be true. Overcoming this fear is possible if you trade in amounts that you can afford to lose if the transaction goes wrong. Day trading is doomed to fail due to market fluctuations, especially when dealing with volatile stocks. Furthermore, the fear of further losses may deter you from taking risks, resulting in the loss of potentially profitable opportunities. Another critical factor to consider in risk and account management is the proclivity to seek quick profits to compensate for a recent run of bad trade deals and resulting losses. Do not change or alter your response and make stupid decisions that you would not normally make. Emotional corruption can stymie your ability to make large profits and expose you to unnecessary risks. Chapter 4. Psychology Discipline. Day traders require a variety of skills, including the ability to analyze a technical chart, to be successful. However, none of the technical skills can compensate for the importance of a trader's mindset. Discipline, quick thinking, and emotional control are all components of trading psychology, and they are critical for success in the day trading business. On the surface, day trading appears to be a simple activity. Markets rise and fall, and traders buy and sell following the price. So, how come 90% of traders lose money daily? The answer lies in trading psychology, which is where the majority of day traders fail. Many online courses advertise to teach day trading or technical analysis, but none teach traders trading psychology. Controlling emotions such as fear and greed are two of the most difficult decisions a day trader can make. Even those who create trading rules and prepare a trading plan find it difficult to stick to those rules and plans while trading in the stock markets. It's similar to dieting. When you're not supposed to think about ice cream, all you can think about is ice cream. Trading psychology is the study of traders' mental and emotional states as they relate to their success or failure in stock trading or trading any other financial security. Trading psychology is more important in day trading because traders must make decisions quickly and trade for only a few hours. It's as if you've been confined to a small time frame. For example, if a person is given 2 options and a time limit of 3 hours, he will choose the easier option. However, if he is forced to decide in 3 seconds, he will panic. In other words, he will experience emotional distress. Risk-taking and self-discipline are 2 aspects of trading psychology. Traders are aware that emotions such as greed and fear should not influence their trading, but they allow these emotions to influence their trading. Traders who are greedy take on more risks than is safe for them. Traders may try to place large trades in a hurry to profit. If their trades are profitable, they may refuse to exit them, even if the exit point has arrived, and continue holding positions in the hope of making more money. Because markets do not continue to trend in one direction, this behavior eventually results in a loss. The market trend eventually shifts, and the profitable position becomes a loss-making one. For traders, fear has the opposite effect, but the same result. Traders who are gripped by fear may close their positions prematurely and then trade again to profit. It becomes a vicious cycle of fear and greed, in which the trader is afraid to keep the position open any longer but continues to trade in greed. As a result, there's overtrading and loss, day trading and fear. Because of technological advancements, news can now travel quickly and to far-flung locations. This has created a unique situation for stock markets, in which positive news causes a quick and positive reaction in the stock markets, whereas negative news causes a sudden and steep drop in stock prices as traders become gripped by fear and panic. Traders still pause and consider whether they are greedy in situations that lead to greed. However, when under the influence of fear, traders tend to overreact and exit their positions prematurely. This has a knock-on effect on markets. Prices fall, traders sell out of fear, prices fall even further, and traders sell even more out of fear. This emotion has a greater impact on stock markets than greed, as traders exit positions for fear of losing profits or incurring losses. When novice traders' positions turn loss-making, the fear of loss paralyzes them. They refuse to exit such positions, hoping for a market rebound and turning their losses into profits. What should have been a minor loss becomes a major one for them, sometimes wiping out their entire trading capital. A rationally thinking person will quickly leave such a situation. However, fear is such a powerful emotion in day trading that it prevents even rational people from making sound decisions. Trading with rules. To protect yourself from psychological risks in day trading, you must eliminate them before you begin trading. A ruled-based trading system is the only thing that can protect you from the emotional roller coaster ride that is the stock market. All aspects of your day trading must be governed by a set of rules, which will include your trading strategy and trading plan. Every day, you must review these rules and trade following them. Before you trade, sit down and consider why you want to start day trading. Are you planning to do it as a side hustle? Are you going to do it for the thrill of the stock market? Or are you doing it to make a point to someone? Many traders fall into the egotistical trap of proving their trading abilities. Instead of changing their trading style, they will continue to trade against the market and expect the market to change its course. If you're starting in day trading to make a living, keep this in mind at all times. You cannot be distracted by small profits and losses and trade indiscriminately. Earning a living should be your goal, and it should be your goal of day trading every day. Before you trade, remind yourself that you're doing it for a living, not for the sake of short-term thrills. As a result, if you suffer a loss, remind yourself that difficulties are a natural part of the business cycle. Maintain a neutral mental state regardless of whether you make profits or losses. All of your trades must be carried out following your plans and strategy. Before you enter any trade, understand the risk-reward ratio, why you are entering the trade, and when you will exit with a profit or at a stop loss. Make rules for how many trades you will make each day. What is your maximum loss tolerance for a single session? What is your profit target for a single session? When any of these three criteria are met, trading should come to a halt. For example, if you decide to take only 2 trades in a session, you should stop trading for that session once you have completed your 2 trades, regardless of whether they were profitable or not. If you set a loss threshold of $20 for a single station, stop trading when you reach that loss limit for the session. This will teach you to trade with discipline, and you will consciously try to limit your losses. Profit booking should follow a similar rule. If you've reached your profit target for the day, you can call it a day. This profit goal could be expressed as a fixed amount or as the number of successful trades. Some traders, for example, will stop trading once they have made a profitable trade. This is one of the most effective techniques for dealing with greed. If you have made a profit in stock trading, even if it is small, simply pocket it and exit the market. Otherwise, greed will take over and you will overtrade in an attempt to make more profit, only to end up losing money. The importance of trading psychology. The majority of day traders fail because they begin at the wrong end of the spectrum. They begin by learning trading skills, then move on to money and risk management techniques, and finally, they learn, at least superficially, about trading psychology. The proper sequence of learning day trading should be learning trading psychology first, followed by money and risk management techniques, and finally learning trading skills. Learning technical analysis and how to use technical indicators is a simple process. However, it is extremely difficult to control one's emotions such as fear and greed while trading, or to manage one's money astutely while day trading. When you look at people in various fields, you will notice that the mindset is the primary difference between those who reach the pinnacle of their chosen career and those who remain mediocre. People who train their minds for success, whether in business, science, technology, sports, or any other creative pursuit, are the ones who win the race. Hundreds of thousands of day traders use the same technical analysis methods in intraday trading, but only a few of them succeed in making profitable trades, while others lose money. The difference between successful and unsuccessful traders is determined by their trading psychology. Every trader who attempts to learn day trading is aware that certain rules must be followed. However, the majority of them fail to do so. Thus, if you want to succeed in day trading, you must pay attention to how you react to markets. Stock trading is nothing more than watching the price of a stock rise and fall and trading with the trend. However, traders continue to disregard this simple trading strategy. Day trading occurs 90% in the mind of the day trader and only 10% in the markets. A day trader makes a decision based on what he or she believes will happen in the stock market, rather than what is happening. This is the most common mistake made by day traders, and it is caused by their emotions. Day traders must learn how to manage their trades without emotion to overcome this psychological barrier. They can only do so with the assistance of technology and self-discipline. They cannot profit in the stock market if they lack self-control or do not follow a disciplined trading plan. Chapter 5. Why most day traders lose. With so many advantages to day trading, it begs the question of why so many day traders fail. Why do the majority of these traders fail if the activity is as profitable as it sounds? Understanding why traders fail provides some insight into the common mistakes that traders make that cause them to lose money. As a result, you'll be in a better position to trade wisely by avoiding common pitfalls in such trading. Here are a few of the reasons why traders fail. Relying on chance. Assume there is a new trader in the market named John. John has some market knowledge because he is constantly watching the news, particularly the stock market. John, on the other hand, has never traded. He believes he can try day trading because he has some basic market knowledge. To this point, John has never sat down to write down some stock trading strategies that he could use. So without thinking, he opens an account and buys 400 shares. Fortunately for him, the stock market rises during his lunch hour. After lunch, John decides to liquidate his holdings. His first sale nets him a profit of $100. His second attempt earns him $100 as well. Now, John has the impression that he is a competent trader. He has earned $200 in a single day. Following a careful examination of John's situation, an experienced trader would argue that John's day trading activity could be fleeting. In John's case, if he gains the impression that his strategies are working, he risks losing money. Surprisingly, he may be tempted to increase his stake because he knows he will profit. It is critical to understand that John's strategies have not been tested. As a result, there is no guarantee that his trading activity will generate returns in the long run. The danger that John faces here is that he believes in the untested strategies that he has devised. As a result, he may overlook recommended trading techniques that would have assisted him in avoiding common blunders. Finally, if he loses money, he will be disappointed, claiming that day trading is not profitable. This is the trap that the majority of newcomers fall into. Their initial success in online trading blinds them to the importance of continuous learning in this activity. Strategy abandonment. Assuming John learned from his mistakes and avoided them in future trades, he now relies on a strategy that has helped him find success in day trading for the past year or two. At this point, John believes he has discovered the best strategy for him. However, another issue arises as a result. John realizes that his strategy has resulted in losses 6 times in a row. He's in a pickle, not knowing what to do because he can't keep losing money. So what does John do? He decides to try a different approach. Regardless of the success he had with his previous strategy, John now believes it is time to try something new. Ideally, he will be implementing a new and untested strategy. One thing to keep in mind here is that John is attempting an untested strategy. He is abandoning a strategy that has served him well for the past 2 years. The danger here is that John will end up back where he started. He may suffer losses as a result of abandoning his strategy. You should learn here that randomness can lead to profits as well as losses for a trader. To avoid such randomness, it is recommended that a trader have a solid plan that they follow. This is a strategy that will govern how they trade. A good strategy should lay out its entry and exit strategies. In addition, the plan should specify the money management technique that will assist a trader in using their money wisely. Lack of knowledge. One of the main reasons why most traders fail is a lack of market knowledge. They are in a bind because they failed to educate themselves about stock markets. You cannot consider yourself a trader simply because you buy and sell stocks. Most emphatically not. You must learn how to analyze the securities you intend to purchase. Your broker may not provide you with all of the information you require to become a successful trader. So, don't assume that reading magazines and newspapers will provide you with the market information you require. A wise trader understands the importance of following a profitable trading strategy. They understand why it is critical for them to effectively analyze stock to determine whether or not they are purchasing profitable stocks. More importantly, a wise trader should be aware of the best strategies for effectively managing their finances. Don't believe the day trading myths that are circulating on the internet. Do your due diligence by researching and educating yourself on stock markets. Mindset misalignment. We are emotional beings who live in a human world. Being overly emotional, on the other hand, can be dangerous in an uncertain trading environment. You must work on your emotions to become a successful trader. The topic of trading psychology, which will be discussed later, will educate you on the significance of developing the proper mindset in online trading. Managing your emotions will have a significant impact on whether you end the day with losses or profits. As a result, you must keep your emotions in check. Adaptability to market changes. One thing you can count on is that trading markets will always fluctuate. There is no guarantee that a specific market will rise steadily throughout the buying and selling period. If this were true, everyone would have been a trader. The best traders will always be able to adapt to market changes. They will be able to tell when to buy and when to sell. Before investing in a specific stock, it is a good idea to run a scenario analysis. Following that, you should devise strategic moves to ensure that you make profits while minimizing the possibility of incurring losses, making mistakes, and learning. People frequently say that failing is a necessary part of succeeding. This is correct. Unfortunately, it is one of the primary reasons that day traders fail. A day trader will lose a lot of money if they learn by making mistakes here and there. Most traders are put off by the prospect of putting their money in stocks because of the need for trial and error. Some people even argue that day trading is a form of gambling. To avoid this issue, one should learn from more experienced traders. You will reduce your chances of losing money this way. Similarly, you will learn how to use market volatility to your advantage. As a result, do not choose to learn how to trade by trial and error. You will only lose a lot more money than you anticipated. Unrealistic predictions. Take a break. Day trading is, in fact, a profitable activity that can earn you a living. Nonetheless, you should not be blinded by the fact that losses are possible. Day trading will not make you rich overnight. However, it is a slow and gradual process in which your money will multiply. Traders fail because they try to force returns to compensate for their massive losses. Having a solid plan and sticking to it will assist you in lowering your expectations. You should always keep in mind that you are trading for a living. As a result, patience is essential. Inadequate financial management. The effort you put into developing a viable strategy is the same effort you should put into managing your finances. A trader should stick to a plan that specifies how much money they will risk regularly. The money put at risk should provide the trader with the satisfaction that it is worth the rewards they expect. Having enough funds set aside for trading should not give the impression that one must spend their money on stocks. The more capital you have, the more you should preserve. The bottom line is that traders can deal with the possibility of failure by following a strategy. Sticking to a trading plan shows that you are disciplined enough to know how much money you are willing to risk. It also implies that you will use a successful buying and selling strategy. Most importantly, you will also give yourself time to learn what there is to learn about day trading. Chapter 6. Characteristics of winning traders. While it is relatively simple to make a few trades every day, however, if you want to take your day trading to the next level, there are several traits and characteristics you should strive to cultivate in your daily life. While no one mold fits all successful day traders, they do tend to embody several interesting characteristics in their unique way. Early bird. While trading in New York does not begin until 9:30 a.m., the most successful traders use the early morning hours to catch up on international markets, giving them a better idea of what the day will bring. Having a strong macro perspective is critical for capitalizing on micro changes. Global markets have a strong influence on the Western economy, and understanding one makes it easier to predict the other. Dedicated. According to conventional wisdom, to truly master something complex, such as day trading, you must put in 10,000 hours of practice time. This equates to 8 hours of work per day for approximately 3.5 years. To put it another way, becoming an expert day trader is more akin to a marathon than a race. While it is true that some people, such as those discussed in Chapter 3, have seen huge windfalls in short periods. They are unquestionably the exception, not the rule, and most people require countless hours of experience to understand when the best time to reap the greatest rewards truly is. Learner for life. The best day traders aren't the ones who are certain they've heard and seen it all before. They understand that new and improved techniques are constantly being developed. Being constantly on the lookout for the latest advances in theory and strategy is what distinguishes true professionals from rank-and-file amateurs who will never be able to trade full-time. Markets change daily, so even analysis from 7 days ago can be hopelessly out of date. Don't limit your earning potential. Instead, decide to maximize it every day. Remember, if you want to earn, you must learn. Intuitive. A great trader does not worry about what everyone else is thinking or doing. Instead, they conduct their research and trust themselves when making trades outside of the mainstream. The best wins come from going against the grain, and this is what distinguishes average earners from great earners. Understanding the difference between business hype and cold hard facts will enable you to successfully discover good trades while avoiding the sheep who are fond of listening to bad advice. If you are afraid of trusting your intuition, study more and begin with smaller trades. Early success will boost your confidence in future results. Trust in yourself and success should follow. Always be prepared. The most successful traders have a detailed plan and know how to stick to it without fail. This does not imply blindly following a course of action that does not appear to be working as planned, but it does imply that you prepare every day and know exactly what specifics you are looking for in the trades you pursue. It is critical to stick to this plan because it is all too easy for traders, even experts, to let their emotions influence trades that are then executed without the benefit of prior planning. Learning to manage your emotions will be extremely beneficial in maximizing your trading results daily. Self-aware. Great traders are as comfortable with themselves as they are with their target markets. This enables them to capitalize on their strengths while also being aware of their weaknesses and how to minimize their importance during day-to-day trading. Understanding your weaknesses will allow you to control risk to the greatest extent possible, resulting in great profits every time. Decisive. The most effective traders are those who can not only conduct research and plan ahead of time, but also pull the trigger when the time is right. The market can change in a matter of seconds, and the ability to strike at the exact moment. The iron is as hot as it will ever get can mean the difference between a large gain and a large loss. This isn't about intuition or luck. It's about reading new situations and determining the best way to respond to them at the moment. Self-motivated. The best traders aren't motivated by a boss looking over their shoulder or even bills piling up in the mail. They are motivated by a personal drive for success in whatever they attempt to perform. Only by harnessing your drive to succeed will you be able to devote yourself to properly preparing to trade and trading with the discipline required to go from good to great. Financially secure. The best day traders understand their limits and never make trades that they cannot afford to lose. No trader can be right all of the time. Losses do occur. This fact alone implies that you must have a stable enough financial situation that a single bad trade will not send you into a tailspin, resulting in more bad trades and a lost bankroll. It is critical to maintaining an emotional distance between the trades and yourself to always listen to reason while leaving emotion out of the equation entirely. Measured. Expert traders understand that there is nothing worse than making split-second decisions without fully considering them. Always strive to make proactive decisions rather than reactive ones. Understand all of the possible outcomes of a given situation and what you will do if each of them occurs. Chapter 7. Choosing what to trade. Stocks are possibly the most popular investment tool on the market. They are appropriate for both novice and experienced investors. Let's figure out how to select and purchase appropriate stocks. Select the company's scope. The industry you choose should be based on your interests and experience. If you get the hang of interior design, for example, keep an eye out for manufacturers of furniture and household goods. If you enjoy computer games, look into game developers and video card manufacturers. It is preferable to select several industries rather than just one, as you will need to diversify your investments. You will be more knowledgeable about companies that affect your personal or professional interests. Investigate companies in the selected field. When comparing companies in the same industry, dark horses may be outperforming recognized industry leaders right now. To do so, visit the website of the exchange you're interested in. Of course, becoming a shareholder in a large corporation sounds better and more reliable. However, it is also impossible to ignore second-tier players because their shares can rise at any time. Such gains can make shareholders extremely wealthy. Make a list of companies that interest you. Each of them must be thoroughly researched. Examine the company profile. Examine all of the company's available information. How has it progressed? How has it changed? How have significant events in the company's history influenced the movement of its shares? What are your long-term goals? Quite often, the vector of a company's past movement determines its future development. Pay close attention to the profit and loss statements. Pay attention not only to accomplishments but also to significant failures. It is critical to comprehend how the company handles adversity and what is happening with its stock at this time. This will assist you in assessing your risks at the outset. Don't forget about liquidity. The company and its products must be liquid now and in the future. Find out about company news. The plans of the company have a direct impact on your income from investing in it. If the company intends to release a new product or has made a discovery, this can work in your favor. Everything brand new arouses interest and, as a result, increases the likelihood of rising stock prices, though this is no guarantee of quick returns. A change in leadership, for example, can have an impact on the company's business and, as a result, its value. Do not also believe that businesses always grow quickly. Many of the world's largest corporation stock prices are rising slowly but steadily. Investigate the dynamics of your company and industry. Examine the companies and the industry in which it operates over the last few years. If the growth rate is declining, or worse, negative, then looking in this direction is not worthwhile. Buying stocks after a period of rapid growth is analogous to jumping into the last car of a moving train. Such enterprises' dynamics are generally healthier and more predictable, and predictability always reduces risks. Predict its future based on financial reports and decide whether you want to be a shareholder in a company with such a future. Probable negative events should also be remembered. This will allow you to assess the risks and your attitude toward them more objectively. Analyze analytics. If you haven't skipped any of the previous points, you've already done some research. You can now seek professional advice and learn what they think about the prospects of the companies you've chosen. Large investment banks publish their recommendations regularly. On the internet, you can find the views of prominent experts and professional investors, including on their pages on social networks. Analysts, of course, are not psychics, and they cannot predict the exact scenario. A professional perspective from the outside, on the other hand, can help you see the details that are missing. Furthermore, professional analysts frequently have access to insider information. Analytics from previous years can be studied. This will aid in determining whether previous forecasts were accurate. Create a stock portfolio. During the detailed review of the preceding paragraphs, some of the companies on the initial list are eliminated. Some are in economic decline, while others have already reached the pinnacle of their prosperity, and so on. As a result, you'll have a list of 1, 2, or more market participants. Stocks of a company with better prospects, according to the previous analysis, should be purchased. It is not necessary to focus on a single company from a given industry. You can invest in the stock of 2 or 3 competing companies and then watch to see which one performs better. Try to have stocks from 10 to 12 different companies in your portfolio so that any losses in one asset are offset by gains in others. As previously stated, you must invest in a variety of activities. Investing in stocks and profiting from them is not difficult. And don't be confused by the multi-stage process. In this case, multi-stage is unlikely to complicate the process, but it does facilitate and improve the outcome. A rational approach requires time and your undivided attention. Warned means armed and stocked. The most important thing to remember is that you spend your time and effort minimizing risks and generating income, which stimulates MICEX NYSE or NASDAQ, and familiarize yourself with a list of traded assets. Chapter 8. Do-it-yourself risks. Risks are inherent in stock investing, as they are in any investment. No matter how knowledgeable you are, you cannot avoid these dangers. The only way to deal with these dangers is to reduce your exposure to them. Before you can devise risk mitigation strategies, you must first comprehend them. You must understand the various types of risks and the factors that cause a risk to become a threat to your earning potential. The various types of risks. The risk of losing some or all of the investment's value is referred to as risk. Some risks are directly related, while others have an indirect impact on your stock investment and purchasing power. Risks are inherent in any investment, so don't let them deter you from investing in stocks. Financial danger. Even established businesses are concerned about financial risk. This risk refers to a company's inability to pay its investors. Remember that when a company declares insolvency, the creditors are paid first, followed by the shareholders and investors, if the company is in the process of liquidation. When a company declares bankruptcy, shareholders may not be able to recoup their investment value. The risk of interest rates. It is used to demonstrate the impact of an interest rate increase after purchasing an investment. This type of risk is frequently associated with investments that generate liability or investments that require the payment of interest to investors. Bonds are an example of a liability-generating investment. Interest rate risk has an impact on a company's financial condition, particularly for companies that rely on debt instruments to raise capital. This risk has an impact on stock investments. When a company issues bonds and other debt instruments and suffers from unexpectedly high interest rates, its ability to pay may be jeopardized. Higher interest rates imply higher interest payments. This means that the company must first pay its creditors before it can pay its investors. As a result, stock prices may fall or dividend payments may be delayed. Stock investors tend to sell their shares when interest rates rise, especially in the electric and financial industries. These investors may choose to invest in debt instruments rather than stocks. Expert investors diversify their portfolios to reduce interest risks by investing in money market instruments that perform and earn, even when interest rates are high. Market danger. Market risk is the movement of demand and supply in the market. When a type of share is in high demand and its supply is limited, its price rises. In contrast, when no one wants a particular stock, its price falls. Stock prices and values fluctuate in response to market demand. This is why the stock is a risky investment in the short term. Because of the millions of investors who buy and sell stocks every day, the stock market is volatile. A stock's price rises in 1 minute. The same stock's price drops the next minute because no one decides to buy it. Aside from demand, other factors such as the issuing company's financial condition, political and governmental situation, and inflation may have influenced the rise and fall of a stock's price. The point is, don't put your money into stocks if you don't know what you're doing. Ignorance can cost you a lot of money. Risk of inflation. Inflation risk refers to a decrease in investors' purchasing power. You can't buy the same item for the same price and quantity as you could years ago. 5 years ago, for example, $1 could buy 10 candies. You can still buy the same brand of candies for $1 today, but the quantity is reduced. Perhaps you can only buy 5 or less today. How does this risk influence your stock investing strategy? Assume you buy a stock that pays a 4% dividend and put the rest of your money in a bank that pays a 4% interest rate. You are, in effect, earning. With increases in interest rates and the financial condition of the issuing company, your first investment could be jeopardized. Your second investment is secure and will not be jeopardized by a higher interest rate. Because you invested the remainder in a bank, your money earns whatever interest the bank uses. The inflation rate, on the other hand, is around 5%. Your earnings are less than the rate of inflation. This means that your bank investment is losing money. Risk of taxation. Tax risk is a reduction in what you can get. The goal of stock investing is to accumulate wealth. When there is wealth, there is a tax. You must pay a portion of your tax obligations. This means you must be tax savvy to avoid paying more taxes than you earn. Political danger. When the government issues new rules and regulations, some businesses are impacted. Others may even go bankrupt as a result of a specific law, while others may profit from the same law. Companies can either die or live in a toxic and unfair political environment. As a result, it doesn't hurt to have a basic understanding of how countries' politics work, because political and governmental conflicts can have an impact on a company's financial condition. Companies may become political targets in some countries. Personal and emotional danger. Personal risk is defined as your inability to increase your investment when an opportunity presents itself. This could also refer to your inability to keep investment going because you require cash right away. The first scenario occurs when you have enough money to invest, but are hesitant to do so. It's also possible that you don't have the money because you spent it in an emergency. The second scenario occurs when you do not have an emergency fund to cover unexpected expenses. When you start stock investing, the first thing you should do is make sure you have an emergency fund. If you skip that step, you will be more likely to encounter these scenarios sooner or later. Emotional risk is the inability to control your emotions when deciding whether to buy or sell a stock investment. Most of the time, investors allow their emotions to override their rational thinking. In stock investing, you must either be greedy for more or fearful of losing money. When investing in stocks, you should learn to control these extreme emotions. How to reduce risk. Stock market investing entails numerous risks, but mitigating these risks is simple and attainable. Don't let these dangers keep you from investing. Risks should not be your primary criterion for deciding whether or not to invest. Stop. Gather information and learn. Gather as much information as you can before investing your money in stocks. Learn everything you need to know about investing in stocks. The more information you have, the better your chances of making and selecting winning stocks are. If it takes you years to grasp even the most fundamental concepts of stock investing, so be it. The important thing is to minimize the risks of investing money in a venture about which you know nothing. You could argue that the best teacher is experienced, but that does not mean you should go into battle unprepared. If you don't think you're ready, don't start buying stocks, even if a financial advisor tells you to. Financial advisors may be experts in their field, but they will not bear the brunt of the loss. Remember the fundamentals. Always remember the fundamentals whenever you feel strong enough to fight. Maintain your equilibrium by returning to the fundamentals of stock investing. These fundamental concepts can assist you in achieving your objectives without incurring significant financial losses. Diversification. A mix and match approach to stock investing is referred to by this term. You do not focus on a single investment. Your portfolio is made up of short, intermediate, and long-term investments. The percentage is determined by your investment style. If you are an aggressive investor, you will put the majority of your money into short-term and intermediate-term investments. Long-term investment receives a lower percentage. If you are a conservative investor, you most likely invest a large portion of your money in long-term investments. Only a small percentage is focused on the short and intermediate term. Another way to diversify is to invest your money in various financial instruments. Because the stock market is volatile, do not concentrate your investment funds solely on stocks. Chapter 9. Opening Range Breakout. Now we'll take a look at another well-known trading strategy known as the Opening Range Breakout, or ORB, strategy. This is a good strategy because it indicates an entry point but does not specify a profit target. You will be able to select the best profit target based on some of the other strategies discussed in this guidebook or by looking at some of the available charts. The ORB will only be used as an entry signal, but to complete the trade properly, you must also define the stop-loss exit and the proper entry. Because of all the buy and sell orders that flood into the market right away in the morning, the stocks in play will experience very violent price action when the markets open. This trading usually occurs during the first 5 minutes of the market day as a result of the loss or profit made by people who held their positions overnight. There will also be a large number of new traders and investors who want to get into the market as soon as possible in the morning. Some investors will panic if they notice that their position has decreased during the night, and they will sell their stocks. There are also a lot of new investors who will see that a stock is cheap and will buy it right away before the price rises. Both of these will influence the price of the stocks and how they perform throughout the day. As an investor, you should wait at least 5 minutes before investing in this opening range. When there is so much change in the market, it is difficult to predict whether the buyers or the sellers will win. It is best to wait at least 5 minutes before making any trades with this strategy, but some traders will wait up to an hour to improve their chances of identifying the balance of power available between sellers and buyers. After the opening, the trader can work on their trade plan based on the 30-minute or 60-minute breakout. Some will work with even shorter time frames, such as a 15-minute breakout. The longer the time frame that you use for this, the less volatility you will find in the market, and it will change what you do. This ORB strategy, like many of the other setups you're working with, works best with large or mid-cap stocks that don't have large price swings throughout the day. You should avoid using this strategy if your stocks have a low float. If at all possible, choose a stock that can trade within a range that is smaller than the ATR or average true range of this stock. You can calculate this number by observing the highs and lows of your candlesticks. To use the opening range breakout strategy, go through the following steps. Following the creation of your watch list early in the morning, it is time to monitor the stocks for at least the first 5 minutes of the market opening. You should be able to identify their price action as well as their opening range. Examine how many shares are being traded at that time to determine whether the stock is rising or falling. Are there a lot of orders coming through here, or is it a high volume with only a few large orders? It is critical to examine the number of orders placed because this demonstrates how liquid the stock is. You must ensure that you can calculate the ATR. You want to make sure that the opening range is much smaller than the ATR in this step, so keep that number handy. After the first 5 minutes of trading, you may notice that the stock is still trading in its opening range for a little while longer. However, if the stock begins to break out of the opening range, it is time to enter the trade. You'll want to enter a trade in the direction of the breakout, long for an upward breakout, and short for a downward move. For a long position, you should set your stop loss below the VWAP, and for a short position, you should set your stop loss above the VWAP. You'll also want to select a reasonable profit target. You must first examine the daily levels throughout the day before identifying them in the pre-market. You can also look at the previous day's close and the moving averages on your daily chart. If there isn't a good technical level for your profit target and exit, if you are long, you should look for signs of weakness in the stock. If you are taking a short position, you should exit when the stock is strong. For example, if the price falls to a new low, it indicates that the market is weakening, and if you are long, you should consider selling your stock. If you take a short position and the stock makes a new high, that is a good sign of strength, and you should consider covering that position to help you out. This is an example of working with a 5-minute ORB, but the same concepts can be applied to 15 or 30-minute opening range breakouts, depending on what you want to do with the market. This is a great option to go with because it ensures that you will not be fooled by the changes that occur right at the start of the market, but you will still get a good idea of how the market will go for the day. Make sure that you are not supposed to trade with the ORB for the first 5 minutes or more in the morning because the market is simply too volatile, but you can still use this information to help you get started on the right foot and to give you a way to make a lot of money with your trading. Strategy. Chapter 10. Tools and Platforms. An online broker and an order execution platform are the primary tools you'll need for day trading. You will also require a high-speed internet connection and a computer to execute your trades on the platform. You'll also need a stock scanner if you're not already a member of a day trading community. The agent. You'll need a good broker who will provide you with access to the securities market, such as the stock market where you intend to day trade. Keep in mind that your broker cannot simply be good. He or she must be exceptional. Why? Because you cannot directly access the stock market or other securities markets, you must go through a broker. Even if you choose your SIPs correctly, you can still lose money in your trades if your broker takes too long to execute your order at your target price or if their system is prone to glitches. It can be difficult to choose a broker because there are so many of them. Some provide excellent service but are expensive, while others charge very low fees but provide poor service. Worse, some are both expensive and of poor quality. To help you narrow down your options for quality brokers, I'll provide a list of really good ones in the appendix at the end of this book. Equity Minimum Requirement. The Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA, of the United States enforce rules on day traders. They use the term pattern day trader to describe people who can day trade with stock brokerage firms in the United States. Pattern day traders are defined as those who day trade, that is, take and close positions on the same day, at least 4 times in the last 5 business days. Before day trading, pattern day traders must have a minimum equity balance of $25,000 in their brokerage account, according to the SEC and FINRA. When a pattern day trader's equity falls below this amount for any reason, brokers are obligated to prevent them from executing new day trades until they can bring their equity back up to at least $25,000. Many newbie day traders, particularly those with only this minimum amount, see this rule as more of a hindrance to day trading glory than a protective fence against day trading disasters. They are unaware that it is intended to keep them from taking excessive day trading risks, which can quickly wipe out their trading capitals due to their brokers' commissions and fees. While this rule is the legal minimum, many brokers and dealers may use a stricter definition of a pattern day trader when transacting with them. To avoid confusion later on, it is best to clarify this minimum equity requirement with your chosen broker. You can trade with an offshore broker instead if you can't afford the $25,000 minimum equity requirement for day trading. They are brokerage firms based outside of the United States, such as Capital Markets Elite Group Limited, which is based in Trinidad and Tobago. These brokers are not subject to the pattern day trader rule because they operate outside of FINRA's jurisdiction. As a result, you are not subject to the same minimum amount. Direct access and traditional brokers. Traditional brokers typically reroute their customers' orders, including yours, to other firms via some sort of pre-agreed upon order processing scheme. As a result, executing your orders through traditional brokers requires more steps and can take significantly longer. When it comes to day trading, speed is everything. Conventional brokers are often referred to as full-service brokers because they offer additional services to their customers such as market research and investment advice, among other things. Due to these extras, their commissions and fees are typically much higher than those of direct access brokers. Traditional or full-service brokers are ideal for long-term investors and swing traders because they aren't as concerned with trade execution speed as day traders are. Direct access brokers prioritize trade execution speed over research and advisory services when compared to full-service or conventional brokers. In addition, because they frequently skip the extra services to focus on providing quick and easy access to the stock market, they charge lower commissions and fees. As a result, many of them have earned the moniker discount brokers. Direct access brokers use extremely powerful computer programs and provide customers with online platforms from which to trade the stock market, whether it's the NASDA key or the NYSE. And while they provide the necessary trade execution speeds for day trading, they aren't perfect. And they have their drawbacks. The imposition of monthly trading volume quotas is one such challenge. If you don't meet their minimum monthly trading volume, they'll charge you an inactivity fee, which often doubles as their minimum monthly commission from your and all of their other clients' accounts. Inactivity fees are not charged by all discount brokerage firms. Another issue that direct access brokers face is newbie day traders who are unfamiliar with direct access trading. With traditional brokers, a newbie trader only needs to tell their broker the details of their orders, and the broker will handle everything related to executing their orders in the market. With direct access brokers, the day trader executes the orders himself or herself via the broker's online platform or software. This can be difficult for inexperienced day traders because, in addition to selecting their SIPs, they must also understand how to properly execute their orders on the platform. However, because day trading is a more sophisticated form of stock market trading, newbie day traders are likely to have prior experience with direct access trading. The platform for trading. The computer program or software that you will use today to trade is referred to as a trading platform. This is distinct from the direct access broker, but many traders mistake them for the same. You'll use the trading platform to send orders to the stock exchange, which the direct access broker will clear on your behalf. While not the same as direct access brokers, it is not uncommon for such brokers to develop and have their clients use their proprietary trading platforms to trade stocks on the exchange. The number and quality of trading platform feature influence the fees that direct access brokers charge their clients for their services. The higher the commissions and fees, the more features a platform has, and vice versa. Hotkeys are an extremely important feature to look for in a trading platform. You may not be able to execute trades quickly enough to make them profitable if you don't have them. Given that day trading focuses on stocks with high volatility, being a second or two late can mean the difference between taking and closing positions at optimal prices and miss out on profitable day trading opportunities. Market data in real time. Unlike long-term investors and swing traders, who only require end-of-day price data that is freely available online, day traders require real-time data as the trading day unfolds because they must enter and exit positions within hours, minutes, or even seconds. Unfortunately, access to real-time intraday price data is not free, and you must pay monthly fees to your direct access broker or the platform owner. If different from the brokerage firm, for it, simply inquire with your direct access broker about the monthly fees for access to real-time day trading data. The bid and ask prices are two of the most basic types of data that you'll need to look at as a day trader. The bid prices are the prices at which other traders and investors are willing to purchase a specific stock. The asking price is the price at which other traders and investors are willing to sell a specific stock. The bid and ask prices are arranged so that the best price is displayed first. The highest bid price is the best bid price, i.e., the best price for sellers is the highest price at which buyers are willing to buy. It is regarded as the best price from the buyer's point of view. Bid and ask prices also show how many shares other traders and investors are willing to buy or sell at specific prices. Bid prices are typically listed on the left side, while ask prices are typically listed on the right, so that the best bid and ask prices are right beside each other. If you want to immediately execute your buy orders, you buy up the best ask price. If you want to execute your sell orders right away, sell down at the best bid price. Trading orders for the day. Market, limit, and marketable limit orders are the three most common types of day trading orders. Orders to buy or sell stocks at their current market prices for immediate execution are referred to as market orders. If you recall, these terms referred to either buying up at the best current ask price or selling down at the best bid price. Market orders may be the worst or best prices to trade in, depending on market conditions and subsequent price movements throughout the day. For example, if you send a market order to sell when the bid-ask prices are $1 to $1.05 and the bid-ask prices shift to 95 cents to $1, 1 cent by the time your order hits the market, your sell order will be completed at 95 cents. In this case, your sell proceeds are reduced by at least 5 cents multiplied by the number of shares sold. Let's say, on the other hand, you sent a buy market order when the current bid, ask price, is $1.10 to $1.15. If the bid ask prices change to $1.12 to $1.17 by the time your market order is executed, you will pay 0.2 cents more for each share of that stock. Market orders are only available to market makers and professional traders with extensive day trading knowledge and experience. Market orders should be avoided as much as possible by retail day traders like you and me. Why? Scanners for stock picks and watch lists. Because there are thousands of stocks that are eligible for day trading every trading day. Manually scanning the market for SIPs fast enough to make timely day trades is impossible. That is why you will need to use market scanning software to narrow down your day trading options. Chapter 11. Charting. A chart is a graphical representation of the price of an asset over time. It has characteristics such as price point, price scale, and time scale. The price scale can be found on the right side of the chart by the day trader. From top to bottom, the scale goes from lowest to highest. Even though it is such a simple concept, the price scale can have a complex structure. The space between the price points in a linear price structure is of equal size. If the difference between the first and second price points is 10, the difference between all price points will be the same. A logarithmic price structure has distances between two price points that change by an equal percentage. This means that if the price changes by 25%, it will apply to all price points. The time scale, which is located at the bottom of the chart, is a date or time range. If he chooses a shorter time frame, the day trader will see a more detailed chart with each data point displaying the asset's closing price. Some charts also display the open, high, low, and close prices. An intraday chart can show price movements over a specific period in a single trading session. A day trader can expect a timescale of as little as 5 minutes. A daily chart can show a series of price movements, with each trading session represented by a single point, which can be the open, high, low, or close price. Chart varieties. Chart of open, high, low, close OHLC. These are also known as bar charts, and they show the relationship between the highest and lowest prices in a trading period. They usually have a tick to show the open price on the left side and a tick to show the closing price on the right. Diagram with points and figures. This makes use of numerical filters that refer to times without fully utilizing the time to construct the chart. Overlays. These are typically used on the main price charts and come in a variety of forms. Resistance. A price level that acts as the highest level above the normal price. Support is the inverse of resistance and appears as the lowest price value. A trend line is a line that connects two peaks or troughs. Two trend lines that are parallel to each other are referred to as a channel. Moving average, a type of dynamic trend line that considers the market's average price. Bollinger Bands are charts that display the rate of volatility in a market. The average of the high, low, and closing price averages for a particular stock or currency is referred to as the pivot point. Indicators based on prices. These examine the market's price values. These are some examples. Advanced decline line. This is a market breadth indicator. The average directional index indicates the market's strength of a trend. Commodity channel index aids in identifying market cyclical trends. The relative strength index, RSI, is a chart that shows the price's strength. Moving average convergence, MACD, the point at which two trend lines converge or diverge. Stochastic oscillator. This displays the close position that occurred within the most recent trading range. Momentum. This is a chart that shows how quickly the price changes. Heikin-Ashi. Candles are used as the potting medium in Heikin-Ashi outlines, but the cost is defined numerically differently. Instead of the standard technique of candles deciphered from fundamental, open, high, low, close criteria, costs are smoothed to all the more likely to show inclining value activity. As indicated by this equation, close equals open plus high plus low plus close, divided by 2. Open equals open plus high plus low plus close, divided by 4. High equals highest of high, open or close lowest of the low, open or close. Usual terms. Average genuine range. The range over a specific period, typically day to day. Breakout. When a price breaks through a zone of support or resistance, regularly due to an impending flood of purchasing or selling volume. Cycle. Periods in which value activity must follow a specific example. Dead feline skip. When prices fall in a down market, there may be an increase in cost as buyers come in accepting a small advantage or selling exaggeratedly. However, when vendors further depress the market, the transitory purchasing spell is known as a dead feline skip. Average is the Dow hypothesis. Advocates of the hypothesis claim that if one of them begins to drift in a certain direction, the other will most likely follow. Many traders are interested in the transportation sector because it can provide insight into the economy's strength. A high volume of product shipments and exchanges indicates that the economy is in good shape. Doji, a flame type characterized by a close to zero difference between the open and close value, indicating market trepidation. Elliott wave hypothesis. The Elliott wave hypothesis proposes that markets go through repeating periods of good faith and cynicism that can be predicted and thus prepared for trading opportunities. Fibonacci proportions. Numbers used as a guide to determine support and opposition. Sounds. Harmonic trading is based on the possibility that value patterns repeat themselves, and market-defining moments can be identified using Fibonacci arrangements. Candlestick diagrams. Candlestick charts are simple to understand and use, and they provide the most feedback to traders by indicating where a price moves in a given period. They also allow him or her to include information about timeframes. In this case, he or she can identify the highest and lowest price points, as well as the last closing price that occurs during that period. Candlesticks help traders get precise visual readings of the market by displaying only relevant information, such as the Heikin-Ashi chart, which shows trends and reversals. Different candlestick charts also depict market aspects such as time, volume, and price movements. Some candlestick charts only use price movements to assist a day trader in identifying resistance and support levels. The resistance levels represent the highest trade highs, while the support levels represent the lowest trade lows. Renko is an example of a candlestick chart that uses colored bricks to reflect trade trends. When there is a downward trend, the visible blocks are black, while when there is an upward trend, the visible blocks are white. The bricks also move in response to price changes, with a new white or black block appearing in the following column if the price moves above or below the previous one. Other candlestick charts can assist a day trader in identifying reversal points and sets of swing highs and lows. These charts allow him or her to identify areas and conditions of bias in the market, assisting him or her in making appropriate moves that result in profits. A KG chart, for example, uses price direction changes to signal reversals. The intraday trader establishes a specific reversal amount, and the price direction shifts to the opposite side once that percentage is reached. It also shows swings in high and low line signals, with the lines becoming thinner as the market falls below the previous swing. In contrast, as the stock rises above the previous swing, the line thickens. Bar graphs. Because they use color, horizontal, and vertical lines to reflect range or price in a given period, bar charts provide a day trader with signals that are simple to read and interpret. The horizontal lines represent the closing and opening prices, while the vertical lines represent the price range for a specific duration. Additionally, traders use them in conjunction with candlestick charts to reflect the market trading activity. A candlestick bar depicts the trading range by varying the low and high values. The high state is represented by the top of the candle or wick, while the low state is represented by the bottom of the candle. Furthermore, the chart employs different colors on the candlestick to indicate the opening and closing prices over a given period. A red candle may represent the closing price at the candle's low end and the opening price at the candle's high end. Meanwhile, a green candle reflects its price in the opposite direction of a red candle. Line graphs. Line charts show an intraday trader the history of prices by keeping track of the market's closing prices. The lines are formed by the trader when he or she connects several closing costs in a given time frame. He or she employs line charts, as well as other types of trading charts, to obtain critical information for a successful day trading experience. Time frame-based charts. All of the trading charts that a day trader uses have time frames that he or she has set based on his or her goals or trading strategies. The trader can use intraday charts that are divided into 2-minute, 5-minute, 15-minute, and hourly intervals. Each time interval represents the price actions of an interesting trade, and he or she can use the information represented to make relevant trading decisions and moves. Charts for free. An intraday trader can use free charts that are available online, which provide the trader with not only technical analysis tools but also advice, demonstrations, and guidelines on chart analysis. Different free charts offer different features such as delayed futures data, real-time data, time frame selection, and indicator accessibility. Additionally, these charts allow a trader to participate in a variety of markets such as forex, futures, stock exchanges, and equity markets. Free stock charts and the technician are two examples of free charts that an intraday trader can access and use for free. Fibonacci sequences. The Fibonacci number sequence is formed by beginning with 1 and adding the previous number. For example, 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, and 8 plus 5 equals 13. Fibonacci numbers are therefore 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, and so on. A Fibonacci number is equal to 1.618 times the Fibonacci number before it. A Fibonacci number, in turn, equals 0.618 times the Fibonacci number after it. Analysts forecast changes in trends by employing 4 popular Fibonacci studies: arcs, fans, time zones, and, most notably, retracements. The retracement levels on a Fibonacci scale of 0 to 100% are 38.5%, 50%, and 61.8%. It's amazing how many creatures in nature, including humans, are proportioned precisely to those ratios. Those familiar with Elliott wave theory are aware that wave counts follow the Fibonacci numbering sequence. As part of their charting features, many trading software platforms include Fibonacci studies. I'll recommend that you apply the retracements to your E-mini S&P futures chart later. How fascinating, you mutter as you scratch your brow. But what does this have to do with me making a lot of money in the market? Plenty, particularly with the numbers 2, 3, and 5. We'll keep the numbers 2, 3, and 5 at the forefront of our minds from now on. These numbers appear frequently on charts, and we use them to forecast price movement. In later chapters, we'll go over Fibonacci levels in greater detail. Stocks in strong uptrends typically move up for 3 days, then down, pull back for 2 days. Alternatively, they move up for 5 days and then retrace for 3 days. In a downward trend, reverse those figures. 3 days down, followed by 2 rally days, or 5 days down, 3 days up, is a likely pattern. If a stock falls for 4 days in a row, you can bet it will remain in the red on the 5th. This is always the case, except when it isn't. Chapter 12. Support and Resistance. Let's get right to the meat of the matter. Support and resistance levels are critical for profiting from the market's short-term fluctuations. Support. Support is a level below which the stock is unlikely to fall. It is a support area for the stock price, and buyers are waiting for the stock to reach this level before purchasing it. These are not arbitrary areas. They have special significance and are frequently based on areas that previously served as support, previously bounced and headed higher. These support areas are targeted for failure so that the position we take on the short side has a better chance of being correct. This is where we want to be a part of a downward movement. This is somewhat counterintuitive for most people who would view this area as a buy zone, as most people do. We can take advantage of the stock's up and down moves for security because we are not biased in the direction of the stock. This area of support will fail, and once it does, the chances of the short position being profitable are extremely high. On a stock chart, here's an example of support. GPRO's 6-month chart is shown above. Check your trading platform to confirm the stock period. I've marked the locations where a clearly defined support area failed. Under this point is an excellent place to short the stock and use that area as a stop loss if it crosses back above that level. This is a simple illustration of what support areas look like and what you should look for when attempting to trade stocks after the support area breaks. To summarize, a support area is one where the stock has difficulty falling below. The more frequently a stock touches a specific area on a chart, the more important that area becomes in terms of support. The larger the area of support becomes, the longer it will hold, and when it breaks, the move down will be quick and extremely profitable. Areas that are more important than breaks will have more meaning when and if they break, and thus, more money can be made from them when trading in the direction of the break. This is an advanced technique, but a support area should be touched more than 3 times in the time frame you're considering. If the support area is breached, the size of share trades should be increased to capitalize on the potential move that will occur when the break occurs. Resistance. Support is the polar opposite of resistance. This is a chart area where the stock has a hard time breaking through. The resistance area is where we look for them to break so that we can buy the stock and participate in an uptrend. I know this sounds strange, but most stocks that hit a resistance area, as the name implies, typically hit this area and then reverse. The stocks that have the potential to break through this level are the ones we want to buy for the potential upside movement here. Here's a picture of a stock with a developing resistance level. CSAL is depicted in the above graph. We can make a few observations. We see the stock in a downtrend and it makes a low, then a few resistance areas, and then another low, forming a price action channel. Typically, we look for another phase of the chart to begin within this price action channel. We'll get into this a little later, identifying the charts we like to trade and why, which is the important part. The level at which the chart has had difficulty breaking through is what we are attempting to identify here. The visuals aid in determining what to look for, how to make use of them in trading. Support and resistance levels enable us to determine the turning points for all stocks. These are high-risk areas for the stock and should be prioritized when reviewing and preparing for the trade. The support breakdown should always be used to bet on the stock continuing in that direction until it reaches another support area. Resistance breakouts enable a trader to profit from an uptrending stock movement. Resistance breaks should be used for long trading or betting that the stock will rise. We will discuss where to place stops for these two basic types of trades. Candlestick patterns are irrelevant to us because they are too imprecise. Looking at how the chart is behaving in terms of price action allows us to make informed decisions about the stock's direction and whether it will continue on its current path or reverse. Profits are made by traders who are aware of this information. Chapter 13. Classic chart patterns. Chart patterns inform traders that the price is likely to move in one of two directions after the pattern ends. You must be aware of several patterns, including reversal and continuation. A reversal pattern indicates that the preceding movement will be reversed when the pattern is completed. A continuation pattern, on the other hand, indicates that the preceding pattern will be kept when the pattern is finished. Before you look at specific chart patterns, you should first understand a few concepts. The most important is the trend line, which is drawn to show the commodity's level of support or resistance. A support trend line is a level below which the process finds it difficult to move. A resistance trend line depicts the level that a price finds difficult to break through. Chartists employ a variety of patterns, which are listed below: shoulders and head. This is a popular and reliable pattern for most traders who use technical analysis. The pattern, as the name suggests, resembles a head with shoulders. This is a reversal pattern that indicates that the price may move against a previous trend. When the pattern is completed, the price will almost certainly fall. The pattern usually appears at the apex of an upward trend. Another variation of the pattern is an inverted head and shoulder facing down. It usually appears during an upward trend and indicates that the price may rise. Shoulders and head top. This indicates to the chart user that the price of security is likely to fall. It is a trend reversal pattern that usually forms at the peak of an upward trend. The pattern consists of 4 main stems that must be completed to show a reversal. The formation of the left shoulder occurs when the commodity reaches a new high and then falls to a new low. The formation of the head. Once the price has reached its peak, it retracts to the formation of the other shoulder. The formation of the right shoulder occurs when a peak lower than the peak in the head occurs. When the price falls below the neckline, the pattern is complete. Bottom of the head and shoulders. This pattern is exactly the opposite of the previous one. This signal indicates that the scrutiny will soon increase. The pattern usually appears when a downtrend ends and is considered a reversal pattern, with the direction going up after the pattern is completed. Among the steps are: configuration of the left shoulder occurs when the price falls to a new low and then rises to a new high. Head formation, when the price falls below the previous low and then rises to the previous high. Right shoulder. This sells off, ending at a low price but higher than the previous one with a drop to the neckline. The neckline is formed by the return to the previous level. When the price rises above the neckline, the pattern is complete. Handle and cup. On the chart, this appears to be a cup. The pattern depicts a bullish persistence pattern in which the rising trend pauses and then trades downward before continuing in an upward trend at the pattern's conclusion. It can last from several months to a year, but the common form remains constant. This is usually preceded by an upward move, which then comes to a halt and sells off. This is the beginning of the pattern, after which the security trades flat for an extended period with no discernible trend. The pattern's final component, known as the handle, is a downward move that resumes the previous trend. The elements. There are several components to the cup and handle that you should be aware of. To begin, you must understand that an upward trend occurs before the trend forms. The longer the previous trend, the less likely a large breakout is after the pattern is completed. The cup's construction is critical. It should be nicely rounded, more of a semicircle. The cup and handle pattern indicates that weaker investors are exiting the market while buyers remain for the commodity. If the shape is too sharp, it indicates that the signal is weakening. You must also pay attention to the handle because it indicates the pattern's completion. The handle represents the commodity's descending move following the increasing move on the right side. A downward trend line can be drawn during move to form a breakout. A move above the trend line indicates that a previous upward trend is about to begin. As with most patterns, volume must be considered to confirm the pattern. A double top and a double bottom. These are signs of a reversal. They indicate a desire for security to maintain an existing trend. When this happens, especially when there are numerous attempts to run higher, the inclination reverses and a new trend begins. Top of the world. This happens at the peak of an upward trend and indicates that the previous trend is failing and buyers aren't interested in the trend. When the pattern is completed, the movement shows a reversal and the commodity is expected to fall. The final stage of the pattern is the formation of new highs in the rising trend, after which the price begins to move towards the resistance stage. The pattern is complete when the price falls below the previous move support level, signaling the start of a downward trend. When using this pattern, you must wait until the price breaks below the key level before entering a trade. Doing so before the signal forms can have disastrous consequences because the pattern is only preparing for a reversal. The pattern depicts a push and pulls between sellers and buyers. Buyers are attempting to force the commodity through but are encountering opposition, preventing the rising trend from continuing. After a while, buyers decide to give up and sellers seize control of the commodity, pushing it down on a new downtrend. Just as before, you must consider volume before making a decision, as you must consider the volume of the commodity when the price falls below a certain level. Bottoms on both sides. The double bottom indicates an uptrend reversal. When the existing downtrend reaches a new low, the pattern forms. The move finds all support, preventing the commodity from falling further. When the movie finds the right support, the commodity will reach a new high, creating the commodity's resistance point. The following stage reduces the commodity to its lowest point. However, the commodity finds some support and then reverses course. When the price rises above the resistance level encountered before the move, the pattern is confirmed. For a definite reversal, the commodity must gain support to show a reversal in a downward trend. Triangles. The names, as you can see from the previous chart patterns, leave little to the imagination. Triangle patterns, as the name implies, form a triangular shape. The pattern's essential design is when two trend lines intersect, with the commodity's price moving between the two trend lines. Triangles are classified into three types: symmetrical triangles, ascending triangles, and descending triangles. Symmetrical triangle. This is a continuation pattern that indicates a consolidation trend followed by the continuation of a previous trend. A downward resistance line and an equally climbing support line intersect to form the triangle. These meet at the apex. The commodity price usually bounces between the trend lines towards the apex before breaking out towards the preceding trend. To confirm the pattern, you must examine various aspects depending on the pattern's direction. If the pattern is preceded by a downtrend, look for a break under the support line. The pattern usually ends when the stock price finally exits the triangle, So look for a volume increase in the direction of the breakout. Triangle ascending. This bullish pattern suggests that the price will end higher. The pattern is formed by two trend lines, one flat line that acts as resistance and one rising line that acts as price support. The rising support line, which indicates that sellers have begun to exit the security, is the most significant part of the pattern. After the sellers exit the market, buyers proceed to push the price past the resistance level, resuming the upward trend. Triangle descending. This is an unequivocal bullish signal. It indicates that when the pattern is completed, the price will fall. The pattern is formed by a flat support line intersecting with a downward sloping resistance line. The pattern indicates that buyers are attempting to raise the price but are encountering significant resistance. After numerous attempts, they eventually fade due to sellers outnumbering them, causing the price to fall. Pennants and flags. This is a group of continuation lines that are very similar to one another. The only difference is in the pattern consolidation periods. The flag is shaped like a rectangle, while the pennant is shaped like a triangle. When a spiky price movement is followed by a slanting price movement, the patterns form. The pattern is complete when a price breakout occurs in the same direction as the spike. The movement is the result of a large price shift, market consolidation, or a pause before the resumption of an initial trend. The national anthem. This section of the pattern creates a rectangle-like pattern. This rectangle appears as a result of two parallel trend lines pushing the price until it breaks out. When the price moves through two levels in the same direction, the signal to buy or sell is formed. Always consider the volume when justifying the signal. The penalty. This is a triangle with the lines forming a sort of convergence. The corner. This chart pattern depicts the reversal of movement that occurs within the wedge. Because it has two trend lines depicting resistance and support, the structure is similar to a symmetrical triangle. This pattern, however, differs from the triangle in that it lasts longer, typically 3 to 6 months. Unlike typical triangles, the converging trend lines incline upward or downward. Wedges are classified into two types, falling and rising. The slant distinguishes the two, with a falling wedge slanting downward and an easing wedge slanting upward. Falling wedge. This bullish pattern indicates that the price will most likely break through the wedge and move upwards. Look at the resistance trend line, which should have a steeper slope than the support trend line. The buy signal forms for this construction when price passes through the resistance. Rising wedge. This is the inverse of the falling wedge in that it has a bearish pattern that indicates that the security may be heading downward. The trend lines that make up this pattern usually converge, with all of them slanting upward. Chapter 14. Technical indicators. Technical indicators are tools that assist traders in performing technical analyses on stock charts. Learning how to use technical indicators is a very important skill for day trading. Without it, you will not be able to become a successful day trader. If you want to win medals in competitive cycling events, you must first learn to ride a bicycle. Fortunately, technical indicators are simple and easy to learn, and anyone can find a variety of online resources that explain what they are and how to use them. You can also learn technical analysis by attending offline workshops or lessons. Day traders use dozens of technical indicators, either alone or in combination. The good news is that all technical indicators assist in some way in detecting price movement and indicating appropriate trade entry and exit points. Day traders choose technical indicators that they like and are comfortable using. It is possible to become obsessed with technical indicators and try to use too many of them for chart analysis. However, it is best to use only a few indicators and stick to them for your trade analysis. Using too many indicators can lead to confusion and jumble of crisscrossing lines on your chart. When it comes to using technical indicators, keeping it simple is best. For trading in stock markets, many traders rely on identifying support and resistance levels. Support levels are preferred for buying, while resistance levels are preferred for selling. This is also referred to as buying low and selling high. These are the most important levels to be aware of on charts to trade effectively. Different methods for determining these levels are used depending on market trends. In the stock market, there are 3 types of trends: uptrends, downtrends, and sideways trends, also called range-bound trends. In an uptrend, the price continues to rise. In a downtrend, the price falls regularly. A sideways or range-bound trend, on the other hand, sees the price move up and down within a horizontal range. A slanting trend line depicts the trading pattern in both up and down trends. Lines of trend. The trend line is the first tool we'll discuss. This is the most fundamental analysis tool you will ever encounter. I can almost guarantee that you will find this tool in almost any trading software available. So, what exactly is it? Trend lines are classified into 2 types based on market direction: uptrend lines and downtrend lines. Let's take a look at each of them individually. An upward trend line. As the name implies, this is a line drawn on an upward trend, such as the one shown above. In case you didn't know, an uptrend is simply an upward market movement. When a market rises to form an uptrend, it does so in a zigzag pattern comprised of small troughs and hills. The troughs are also known as support levels. Levels of support are also known as reactions or corrections. These are the points at which the market retraces its steps before resuming its original course. These troughs provide excellent purchasing opportunities. When drawing an uptrend line, these troughs become the touching points. One thing to keep in mind is that the number of touching points on the line must be at least 3 for it to be considered a valid trend line. A line of decline. Then, there's the downtrend line. Similarly, when a market is falling, it will move in a zigzag pattern, as shown above, creating hills and troughs. This line, unlike the uptrend line, is drawn across the hills. These are also known as resistance points or resistance levels. In addition, they provide excellent selling opportunities in a declining market. Averages of movement. Moving averages are slanted indicators that move along with the trend line and highlight major support and resistance areas. These indicators are divided into different periods, such as 20 days, 50 days, 100 days, and 200 days. When markets are trending, day traders use moving averages to find support and resistance points. A sideways trend, on the other hand, is caused by a horizontal movement of price. In such trends, traders must be aware of horizontal support and resistance levels to buy and sell. In range-bound market conditions, day traders use pivot levels or Fibonacci levels to identify support and resistance. These are the most basic indicators. Certain methods are used to calculate pivot levels, and pivot calculators are freely available online. On technical charts, Fibonacci levels are drawn from the highest and lowest price points. All trading charts allow you to draw Fibonacci levels. The RSI, Relative Strength Index, is the third most important and simplest trading indicator. This indicator, as the name implies, indicates the strength of any trend. The RSI is plotted beneath the main charting area and rises and falls in tandem with the price. A rising RSI indicates the strength of an uptrend, while a falling RSI indicates the strength of a downtrend. It has top and bottom areas which are referred to as overbought and oversold. Day traders look to sell near the overbought zone and buy near the oversold zone. One can plan their trading strategies for buying and selling by combining support and resistance indicators with the RSI. Indicators of movement. Momentum indicators indicate the strength of a trend and whether or not a reversal is likely. They are extremely useful for locating peaks and troughs. As such, they can assist in determining when and where to enter or exit a trade. Momentum indicators include the Average Directional Index, ADX, the Relative Strength Index, RSI, and the Stochastic, These indicators are in the lead. Market cycles and oscillators. These are indicators that reflect ambiguous price trends, such as the Relative Strength Index, RSI, and the Moving Average Convergence Divergent MACD. The signals oscillate between upper and lower bounds, and the subsequent readings provide the day trader with information about market conditions. Chapter 15. Moving Averages. Using moving averages to trade support and resistance. Moving averages are the most commonly used indicator for determining support and resistance. What exactly is a moving average? A moving average is a simple indicator. It is simply a line that displays the average price over a specified period. For example, if you set your moving average to 200 periods, it will display the line at the average price for the previous 200 periods. It is critical to remember that a moving average is a dynamic support and resistance indicator, which means it moves in lockstep with the trend. There are several types of moving averages, each with its own set of calculations, but the two most commonly used are simple moving averages, SMA, and exponential moving averages, EMA. EMA versus SMA. A simple moving average is simply the average price over the specified period. An EMA weights the most recent periods more heavily, causing the EMA to move closer to the current price. What are the best moving averages to use? For my trading style, I prefer EMAs over SMAs. EMAs tend to act as more powerful supports and resistance. It is also critical to select an appropriate period for your moving average. The most commonly used periods for moving averages are listed below. Periods with the highest moving average: 377 EMA, 200 EMA, SMA 50 EMA, and SMA 89 EMA. EMA 55, 20, 1 EMA, 20 EMA, and 10 SMA. I recommend only trading with 2 or 3 people at a time. My preferred combination is a 21 EMA, 50 AMA, and 200 EMA. The 200-day simple moving average is probably the most commonly used moving average for support resistance, or also the 200-day EMA. Below the 200 days EMA, the price is acting as support and bouncing. See Figure 4.2. And many traders place buy orders at both the 200-day simple moving average and the 200-day exponential moving average. Moving average support has been converted to resistance when support is breached. It can transform into resistance, and vice versa. Following a break of the 200 days EMA, the 200 days EMA is converted into resistance. See Figure 4.3. Indications that moving average support will be broken. When entering a trade, it is critical to understand that there is always the possibility that moving average support or resistance will break, which is why we use stop losses. We can look for the following warning signs to determine the likelihood of support or resistance breaking. Touches that are repeated. Over a short period, the price has repeatedly touched the support-resistance level. If the price repeatedly touches support, it will consume the buy orders that traders have placed there. The bulls will eventually run out of money to support the price, and support will break. Figure 4.4 shows an example of this. With the price slowly moving sideways on a 21 EMA, we don't want to see the price dribbling sideways along with support. The longer price moves sideways at support or resistance, the more likely it will break. Indicators that are turning the other way or that are overbought, oversold if you use a momentum oscillator, such as a stochastic, and it is just beginning to turn down at support. This is a warning sign that the support may not hold, and vice versa for resistance. In the example below, we can see that the stochastic is oversold at support. See Figure 4.5. If you're using an indicator and it's showing an overbought reading as it approaches to support, this is a good red flag that it might not hold. As shown in Figure 4.5, the stochastic was also showing an overbought reading as the price approached the moving average. When moving average support resistance is broken, how do you know? Price will frequently move briefly below or above support or resistance, and then quickly back above it. For support to be confirmed broken, a full candle must open and close below or above for resistance, and there must be a strong away from the support level as shown in the example below. See Figure 4.6. When support breaks, it is common for it to turn into resistance, as illustrated in Figure 4.6. This retest of former support turned resistance is an excellent opportunity to enter a short trade. Chaikin money flow strategy plus moving average crossover. On our chart, we will add a 12 EMA, a 35 EMA, and a Chaikin money flow, CMF, indicator for this strategy. After we've added these indicators to our chart, it should look like the one below. See Figure 4.7. The 35 EMA is black in this example, and the 12 EMA is blue. Shorting requires the 15 EMA to cross below the 35 EMA and the CMF to be less than 0. See Figure 4.8. In the case of a buy, the 12 EMA will cross above the 35 EMA, and the CMF will be greater than 0. Before buying or selling, I recommend waiting for a retest of the 12 EMA. We want to see a retest of the 12 EMA, and in this case, we want to be short when the price approaches this moving average. While the CMF is still below 0, it is acceptable if it is slightly above 0. See Figure 4.9. In this example, I will wait until the price breaks through the 35 EMA before exiting the short trade. See Fig. 5.1. The 35 EMA can also be used as a stop loss if the retest breaks through. As you can see, this crossover strategy can be effective for capturing good trending moves. Guidelines for moving average crossover plus Chaikin money flow strategy. Buy signal. The 12 EMA crosses above the 35 EMA, signaling a buy signal. The Chaikin money flow is greater than 0. Signal to sell short. The 12 EMA crosses below the 35 EMA. The Chaikin money flow is equal to or less than 0. Time frames for implementing this strategy. This strategy will work in any time frame. The following market conditions are ideal for this strategy. Markets that are strongly trending. Avoid using in markets that are trending sideways or choppy. Tips for using the strategy. Before making your trade, wait for a retest of the 12 EMA. If you use lower time frames, this may be useful in non-tending markets. Risk management strategy based on the moving average. We can use moving averages to manage risk. Some moving averages, when broken, may indicate that a trend is reversing or that a larger drop is imminent. In my trades, I usually use moving averages as exit signals if they are broken. The 10 simple moving average is my favorite moving average for risk management. If the 10 SMA breaks, I consider it a warning sign that the trend may be coming to an end soon. It is important to note that I do not consider a red flag until I see a full candle open and close below this moving average. Here's an example of how I apply the 10 SMA to risk management. See Figure 5.2. Chapter 16. Trading order types. Investors use a broker to buy or sell an asset using their preferred order form. When an investor decides to buy or sell an asset, they place an order. The order instructs the broker on how to proceed. Commercial securities are typically traded using a bid-ask mechanism. This means that a buyer who is willing to pay the selling price must be present to sell. There must be a ready seller to offer the buyer's purchase price. When a buyer and a seller are both present, no transaction takes place. The offer is the highest advertised price at which someone is ready to pay for an asset, and the request is the lowest advertised price at which someone is ready to sell an asset. Changes in the bid and ask are constant because each offer and bid represents a different order. When commands are entered, the rates can change. For example, if there is a 25.25 bid and another bid of 25.26, The next highest bid is 25.25 after all 25.26 orders have been completed. This bid-asked process is important to remember when placing an order because the order type chosen will affect the price at which the trade is filled, when it will be filled, or whether it will be filled at all. Order varieties. Individual and institutional investors both place orders in most markets. Individuals trade, which necessitates the placement of a variety of orders primarily through broker-dealers. Markets allow for a variety of orders, giving traders some leeway in how they invest when planning a trade. The following are some examples of basic types of orders. The market order instructs the brokerage to complete the order at the next available price. Market orders have no fixed demand and are typically executed on all occasions when there is little competition in the exchange. Market orders are typically used when the trader wants the trades in or out quickly, and the price is not a concern. The order cap instructs the brokerage to acquire the security for no more than a specified amount. Limit orders ensure that a customer only pays a specific security purchasing price. Limit orders can remain in effect until they are executed, expired, or canceled. The sell limit order instructs a broker to sell the asset at a price higher than the current price. This type of order is used for long positions to profit as the price rises since the purchase. The brokerage is instructed by a sell stop order to sell if the asset is or reaches a price lower than the current price. A buy stop order may instruct the dealer to acquire an asset until it reaches a price that is higher than the current price. A market order is a stop order, which means that once triggered, it can take any price or order of stop limit it can be, and it can only be executed within a given limit. Price range. After triggering, day orders must be completed on the same business day that they were placed. Good until orders are canceled. Orders are good until they are filled or canceled. If the order isn't an order of the day, or isn't good until the order is canceled, the trader typically sets the order expiry. You must complete a kill or fill orders quickly and completely, or they will not be completed at all. These types of orders have an impact on trade results. A buy limit placed at a lower price than the asset is currently trading at, for example, can provide a better price to the trader if it decreases the asset's value in comparison to now buying. However, keeping it so low implies that the price will never reach the limit value. So if the price falls higher, the trader may lose out. One type of order is not superior to another. That order style serves a purpose that, in some cases, would be the better option. Use of an order for a stock trade. A trader will consider how they will get in while purchasing a product and how they will get out on both a loss and a profit. This means that there are potentially 3 orders that can be placed at the start of a trade. One to enter, one to control the risk if the price does not move as expected, as referred to as a stop loss, and another to trade profit eventually if the price moves in the expected direction, known as a profit target. An investor or trader should not place their withdrawal orders at the same time they begin a transaction, but they will be informed of how to exit with a profit or loss, and what forms of instructions they should use to do so. Assume a broker decides to purchase AAPL, Apple Inch. One possible configuration is that they use this to place orders for business while also controlling risk and profit. We monitor an exchange alert technical indicator and then place a buy order for the product at $124.15. The total cost of the order is $124.17. Slippage is the difference between the quality of the sales order and the quality of the fill. They agree that they do not want to bet more than 7% on the product, so they placed a sell stop order at $115.48. 7% below their entry. That is victory over defeat or failure. Based on their research, they conclude that they should make a trade benefit of 21%. implying that they intend to lose 3 times. That is a very favorable risk-reward ratio. As a result, they place a sell limit order at $150.25, which is 21% higher than their entry price. For them, this is the profit goal. First, there will be a selling order, which will close the trade. In this scenario, the trader makes a profit of 21% when the price first reaches the selling limit, market order defined. An investor's BDs and market order usually made through a brokerage or brokerage service for buying or selling a stock at the best price available in the current market. The most reliable and fastest way of entering or exiting a trade is widely considered and provides the best way to get into or out of the trade quickly. For other liquid large cap stocks, business orders virtually instantaneously step in. The basic majority of orders are considered market orders. It is intended to be implemented as soon as possible at the current selling price for defense. That is why other brokerages have a buy-sell trading app button. Typically, this switch is used to perform a business order. In most cases, market orders have the lowest commissions of any type of order because either broker requires very little work. Important takeaways. A market order is an investor's request to buy or sell securities. Large cap options, derivatives, and ETFs, for example, are well suited. A market order will be filled by the trader if he or she is available to buy or sell at the requested price. When should a market order be used? Market orders are well suited for securities traded in extremely high volumes, such as large cap stocks, ETFs, or futures. Orders for the E, mini S, and P are market. A stock like Microsoft, for example, tends to fill quickly and without issue. This is not the case for stocks with low floats or a small total regular value. As a result, stocks are traded thinly, with a widespread asking bid. As a result, market orders for securities like these are sometimes filled slowly and at unexpected prices, resulting in significant trading costs. Market order slippage. It implies that if a dealer wants to fulfill a trading offer, the seller can either buy at the selling price or sell at the bid price. As a result, the market order executing guy immediately leaves the requested bid spread. For this reason, it is sometimes a good idea to take a close look at the spread of the asked bid before placing a market order, especially for securities traded thinly. Failure to do so could result in extremely high costs. It is especially important for those who frequently deal with or use an electronic trading program. Limit order versus market order. Market orders are the most basic types of buying and selling trades. Limit orders, on the other hand, give investors greater price control over the bid or sale price. It is accomplished by establishing a maximum reasonable value for the sales price or a suitable minimum acceptable price of sale. Limit orders are ideal for trading thinly traded stocks that are highly volatile or have larger asked bid spreads. Real-world market order exemplification. Assume the asked bid production cost for excellent industries shares are $18.50 and $20, respectively, with 100 shares available on request. If a trader places an order to buy 500 shares on the market for $20, only the first 100 will be executed. Nonetheless, the upcoming 400 securities are filled at the highest selling price for sales. If the stock is traded very thinly, the next 400 shares could be executed for around $22 or more. This is why using limits for such types of shares is a good idea. Market orders are filled at a predetermined market price as opposed to restricting or stopping orders, which gives traders more control. In some cases, the use of market orders may result in unintended or significant costs. Chapter 17. Trading Strategies. What trading strategy do you employ? Now that you've got a better idea of how to pick a brokerage and set up your home office, let's talk about trading strategies. There is no one-size-fits-all trading strategy. Your strategies will be determined by your personality and style. A strategy that works well for one trader may be ineffective for another. Aside from day trading, you may want to experiment with other trading strategies that have proven to be successful in the past. Past performance does not, of course, guarantee future results. Nonetheless, there may be times when you want a more profitable alternative to day trading. 3 of the most well-known trading strategies are as follows. Trading positions. Position traders, as opposed to day traders and swing traders, hold positions for extended periods, typically several weeks or months, but potentially longer. Position traders, unlike buy and hold investors, will not hold a position indefinitely and will sell when profits or losses are limited. In many ways, position trading is similar to swing trading, but with a longer hold. Trading in swings. Swing traders, unlike day traders, try to capture stock gains over a short period, typically 2 to 5 days. Although they are not bound by any time frame, swing traders typically buy early in the week and sell on the weekend. Many professional traders employ a variety of trading strategies. As a result, under certain market conditions, they may switch from day trading to swing trading. Swing trading, particularly in short-term trend markets, may be the best strategy. Scalping. Scalping was rife before decimalization. That was when traders tried to make a quick 25 cents per share or more in seconds or minutes by trading thousands of shares and earning $200 to $500 per trade. It was much more difficult than it appeared. A few popular scalping books at the time were deceptive. They made scalping sound like an easy strategy that anyone could do, when in fact it's extremely difficult for most people. People may incur significant financial costs as a result of this practice. As a day trader, you'll most likely scalp. That is, enter and exit a stock in seconds or minutes for a quick profit. The idea is to execute a large number of trades, 5 to hundreds, while aiming for smaller profits. However, keep in mind that this is a stressful trading method that can result in commission losses. Trading after hours. The equity markets in the United States typically close at 4 p.m. Eastern Time. Even so, traders continue to have access to the markets until 8 p.m. Platforms such as ECN and exchanges such as the NYSE provide access. As a result, trading the markets after 4 p.m. until 8 p.m. is referred to as after-hours trading, post-market trading, or extended hours trading. The issue with this trading period is that it is extremely illiquid because most trading specialists and market makers avoid trading during this period. The lack of liquidity in the market is the most notable feature of after-hours trading, because there is often very little activity. Many experts consider this to be risky or even dangerous territory. Spreads are frequently very wide because most other traders, particularly market makers, have left for the day. As a result, securities activity is frequently very low. Day traders, on the other hand, understand how to profit from such circumstances. For example, if breaking news is announced during this period, related stocks may experience significant movement that can be traded. Trading after hours is challenging due to the illiquid nature of most securities and the wide spread. The best time to trade after hours is only when there is significant news affecting a specific company or industry. Such information is best received during earnings periods, which typically occur during quarterly earnings reporting periods. As a result, this type of trading should be reserved for experienced traders only. Trading at high frequency. High-frequency trading, also known as HFT, is essentially a set of programs that execute complex algorithms to generate super-fast trades across multiple markets. Arbitrage and market making are among the goals of these quick trades. The thin profits that accrue from the large volume of trades initiated are the standout feature here. On any given day, the number of trades initiated can be in the millions. HFT is said to account for approximately 50% or half of all volume trades initiated in U.S. stock markets. These trades rarely hold a position for an extended period. Low latency is one of the most important ingredients in any HFT operation to maintain a speed advantage over other traders, such as retail traders. HFTs are powered by a modern computer algorithm. If properly implemented, such programs can generate modest to average profits for an extended period while incurring no significant losses. There have been reports of HFT firms operating profitably for 1,000 days without incurring any losses. When everything goes as planned, HFT provides a fantastic opportunity to earn a lot of money with little risk over a long period. Latency. This term refers to the amount of time it takes for data sent between 2 points to arrive at its destination. In general, low latency denotes high speeds, whereas high latency denotes low speeds. Most investment firms devote significant resources to acquiring the most cutting-edge infrastructure and hardware required for processing trades at high speeds. Algorithms. These are basic instructions that must be followed if certain conditions are met. Millions of lines of code are required for a sophisticated algorithm, such as the HFC algorithm used in trading. Algorithms have become commonplace in recent years, and most traders use one type or another to execute their trades. Momentum investing. Day traders prefer momentum trading because the stock market's momentum is where all the action is. This type of day trading seeks to profit from stocks that experience a price increase, particularly when large trade volumes are involved. Stocks and securities in momentum trading are influenced by factors such as margin calls, short squeezes, and stop losses, causing them to move excessively and extremely. The typical approach of day traders to momentum trading is to scalp profits as quickly and as heavily as possible. Day traders who prefer momentum trading typically trade any security with high volatility and volume. These are securities that have experienced a significant price increase and are referred to as high flyers or momentum stocks. The majority of stocks suitable for this type of trade strategy are more volatile than those of major blue-chip companies. This volatility is what draws momentum traders to these trades. Volatility is an excellent way to capitalize on price movements and volume. Securities with high volatility and high volume that are featured in the news are typically the best suited to momentum trading. Price movement is a defining feature of momentum day trading. Traders frequently use shorter time frame charts such as the 15-minute, 5-minute, and even 1-minute charts. To manage risk, the emphasis should be on immediate action with large share volumes. Momentum day traders must be very precise when entering and exiting the market. In this case, executions and charts will be given far more weight than the underlying company's fundamentals. In addition, because news is often the primary driver of momentum, stories in the news carry more weight. In addition, chart patterns and key signals will aid in determining the best times to enter trades. What momentum traders should keep an eye out for? Chart patterns with a high probability. Setups for intraday trading. Volume. Ratios of risk to reward that is reasonable. Options trading during the day. A stock option is yet another trading option that day traders frequently employ. Options contracts, in theory, give the holder the right, but not the obligation to sell or buy an underlying security at a specific price. Options are derivatives. This means that their value is determined by underlying security or commodity. As a result, stock options, like other derivatives, allow the holder to benefit from the underlying security's price movement while also limiting the amount of loss that can be incurred. A stock options trader essentially enjoys the benefits of stock ownership without the obligation or financial ramifications of purchasing the stock. They only pay a fraction of the total cost of purchasing or investing in the stock. Each options contract is linked to approximately 100 shares of the underlying security. So a trader who holds 10 calls or put options effectively controls 1,000 shares of the underlying stock. Options contracts are accepted and traded on many exchanges. These include the International Securities Exchange, Chicago Board's options, and numerous others. This is also because their prices fluctuate in lockstep with the underlying stock. However, unlike stocks, options can lose the majority of their value if they expire. Because this is an inherent feature of all options, they all have an expiry date. Trading in penny stocks. What exactly are penny stocks? These are stocks that trade on the market for less than $5 each. They are among the most speculative shares in the market and are frequently priced at less than $3, if not less than $1. There is always the risk of fraud, speculation, and even pump and dump schemes. However, things have improved, and penny stocks are now regarded as a less expensive way to invest in stocks at the markets. Volumes and liquidity are critical components when trading penny stocks. These two components make it simple to enter and exit trades. It is also critical for any day trader dealing in penny stocks to have direct access to a brokerage to execute trades quickly and seamlessly. Penny stocks have a habit of increasing in volume, then peaking, trapping many traders with expensive shares. Before engaging in such trades, it is critical to conduct extensive research and make use of all available tools and leverage to have the most up-to-date information. The most important thing to remember about penny stocks is that price is everything. So always have an exit strategy in place before starting any trade. Trading before the open. Pre-market trading is another type of day trading strategy. Trading in these markets can begin as early as 4 a.m. EST, even though normal pre-market trading hours begin at 8 a.m. EST. During normal trading hours, liquidity and high volumes begin to flow in. Regular trading begins at 9:30 a.m. EST. Dark pools and ECNs are commonly used for pre-market trading. This is very similar to trading after hours. While there are usually no specialists or market makers in the market at such hours, they may be trading through certain ECNs. Pre-market trading versus after-hours trading. In general, the risks of trading the pre-market are much lower than those of trading after hours. This is because market activity continues after 9:30 a.m. EST, as opposed to after hours when activity simply ceases. Because it closes at 8 p.m., many traders are likely to be trapped in after-hours trading. Such traders will have no choice but to wait until the following morning's pre-market hours. Furthermore, trade may resume with a significant gap against positions taken by traders. Chapter 18. Basic Strategies. You will succeed in your day trading if you follow the advice in this article. Invest in education. It is essential to have a basic understanding of daytime trading procedures. However, as a day trader, it is critical to stay up to date on market news and developments that may affect the stocks they are trading in. This could include the economy's outlook or the Federal Reserve's interest rates, among other things. Follow business news and read from reputable financial websites. Set aside some of your trade capital. You must determine how much capital you believe you will need for each trade. The majority of successful traders risk no more than 2% of their accounts on each trade, always have extra money to trade with, and are willing to lose it. One does not, however, have to lose. Make time. You must set aside time to be successful in day trading. Begin small. When you're a newbie, don't overburden yourself. This means that if a company's stock is selling for $200 and you want to buy $50 worth of shares, you can do so directly. Avoid penny stocks at all costs. As a trader, you may be looking for low prices or deals, but avoid penny stocks. However, if you have not identified a genuine opportunity and have not conducted a thorough analysis, it is best to avoid them. Understand how to time trades. When traders and investors place orders, they begin trading as soon as the markets open in the morning. If you are a beginner, however, it is best to monitor the market for at least 15 to 20 minutes before making any moves. Limit your losses by placing only a few orders. As a player, you must be aware of the types of orders you will begin and end the trade with. Profit expectations should be realistic. As a trader, you must understand that having a good strategy does not always guarantee profitability. Keep your cool. Stock trading can be frustrating at times. Stick to the plan. Successful day traders move quickly, but this should not be confused with thinking quickly. Even with these strategies, day trading is difficult and can be difficult if not executed properly. Why is day trading difficult? This type of trading necessitates the development of consistency and expertise. However, several factors make the process difficult. In addition, the government expects you to pay taxes on any profits you make. How to decide what to buy and when to buy it? Day traders profit by taking advantage of how asset prices fluctuate, and they do so by leveraging massive amounts of capital. Liquidity. The liquidity ratio enables a trader to begin and end trade at a favorable price. For example, you can profit from the difference between the quoted offer and the price at which the stock is being sold, or from the lower spillage, which is typically the difference between the expected and actual price of a stock. Volatility is simply an indicator of price movements. It is the level at which traders are most at ease. Trade volume. This is the number of times a stock has been purchased and resold in a given period, also known as the daily average trading volume. Choosing your entry point. When you know what assets or stocks you want as a trader, you must learn how to establish entry points. Intraday candlesticks provide unaltered price trends for a stock. Real-time news service information influences stock price fluctuations. Enroll in services that will keep you up to date on market-moving news. In Level 2 quotes, ECN stands for Electronic Communication Network. Once you've decided on your entry rules, examine various charts to see if the same outcomes occur daily and if they produce an anticipated price movement direction. Choosing your exit point. There are several methods for exiting a winning position, including profit targets and trailing stops. Among the most common price target strategies are fading, refers to the process of bringing down stocks after they have risen rapidly. Scalping is a very popular strategy. Momentum. A trader uses this strategy to base his transaction on a news release. Another type of momentum trader may choose to short the price increase. Daily pivots. This strategy entails a trader profiting daily from volatile stocks. Ideally, a trader should stop trading in an asset when interest in it has declined. As a trader, you must do your homework thoroughly. Make a list of your preferred stocks to trade in and stay informed about your chosen companies and general market trends. For example, if you have $50,000 in your trading account and decide to take a 0.5% risk per trade, your expected loss per trade is $250. The majority of day traders devote the majority of their day to trading. If you don't have enough time to spare, day trading is not for you. The trading process necessitates the trader to keep track of the markets and identify any opportunities. Constant monitoring is essential because opportunities can arise at any time, and moving quickly is critical. Begin with 2 trades at a time, no more, because it is easier to monitor and identify opportunities with fewer stocks. Recently, traders have begun to trade with fractional shares. This allows a trader to invest in smaller amounts. However, buying 1/5 of a share through a broker may be difficult because many brokers do not allow a person to buy 1/5 of a share. The reason for this is that these stocks are frequently illiquid, and the opportunity to hit a jackpot with them is rare. Many stocks that trade for less than $5 per share are frequently removed from the main stock platforms and can only be traded across the table. This is a major contributor to price volatility. A skilled trader or player must be able to identify patterns and determine the best time to profit. Prices are less volatile in the middle of the day, and trading begins to pick up again as the day draws to a close. The rush hour provides a variety of opportunities, but as a newcomer, it is best to avoid rush hour trading. What kind of orders do you prefer, market or limited? If you decide to use a market order to trade, Keep in mind that it will be executed at the appropriate time and the appropriate price. If, on the other hand, you use a limit order, you will be guaranteed the correct price, but not how it is carried out. This type of order allows you to trade at a specific price target for both buying and selling. It is critical to set a realistic trade price so that it can be executed. Day traders, who are more sophisticated and experienced, may choose to use option strategies to strengthen their position. According to statistics, most day traders will win no more than 60% of their trades and no less than 50% of their trades. It is also worth noting that they make more money on their winners than they do on their losers. A trader must ensure that their risk for each transaction is limited to a specific percentage of their capital. They should also make a note of the time they enter and the strategies they use to exit. As a business owner, you must keep greed and fear at bay. Make decisions based on logic rather than emotion. To be successful, plan ahead of time. Develop your strategy and cultivate the discipline to stick to it. It is more important to stick to your established strategy and formula than to chase after profits. Profits are driven by emotions, and if not managed properly, they can get the best of you and cause you to abandon your strategy. Always plan ahead of time how you will trade and trade following your plan. In this section, we will look at why day trading is difficult. You should be aware that you will be competing with professionals whose careers revolve around trade. They have excellent connections in the industry and technology, so even if they fail, they will eventually succeed. Whether the gains are short-term or long-term, any investment must be taxed. However, if you have any losses, they will cancel out your gains. Individual traders are also susceptible to psychological and emotional biases. Professional traders, on the other hand, can trade without becoming emotionally involved. This occurs because they are not trading with their money directly. As an individual would, a day trader will typically consider the following factors when deciding what to focus on in trading. If the price movement is greater than usual, it usually indicates that stock prices are rising. If the volume of trade is high, it indicates that the stock is popular among traders. When there is a surge in interest in a particular stock, the price of that stock may rise. This denotes the exact time to make your investment. Some of the tools you'll need to do so are as follows. It is a computer system that displays the best bids and asks for quotes from various market participants, and it automatically matches and executes the orders. Level 2 is another service that you must sign up for. It provides real-time access to the NASD A-Key order book, which includes price indicators that are registered with NASD AQ. When used together, these two can provide you with an idea of trade orders as they occur. Once you've done this, you'll have a likely strategy for entry and will need to decide how you'll sell or where you'll exit. Profit targets are the most common exit strategies. This entails taking a profit at a previously determined level. This is based on the belief that the stocks have been overbought, that those who purchase them early are ready to profit, or that current buyers are afraid. This strategy is risky, but can also be rewarding. In this case, the price target is when buyers begin to re-enter the market. It entails selling as soon as a trade becomes profitable. The target figure is the one that will allow you to make a good profit from the transaction. This entails identifying strong trending moves that are supported by a large volume of stocks. A momentum trader may choose to buy on a news release and then wait for signs of a reversal to appear. The exit point for this strategy is when the volume begins to fall. This is done when a trader buys at the lowest point of the day and decides to sell at the highest point of the day. At this point, the targeted gains must include more gains from profitable trades than losses from losing trades. 0.5% $50,000. Chapter 19. Effective methods to manage your money. The truth is that many traders, particularly novices, began with a lot in their trading accounts and ended up with little or nothing to brag about. Many of them lost money as a result of rash decisions or failure to implement a well-thought-out strategy. There are some things you must do to manage your money effectively. Based on your capital, select the appropriate lot size. When you first start learning about Forex trading or financial market trading, you will most likely learn about trading lots. What we mean by a lot is the smallest trade size that can be placed when trading currency pairs on the foreign exchange market. Brokers typically refer to lots in increments of 1,000 or a micro lot. You must understand that the lot size directly determines as well as shows the risk that you are willing to take. Using a risk management calculator or a similar tool can assist you in determining the appropriate lot size based on the assets in your trading account at the time. This can be used when trading in life or simply practicing. It informs you of the maximum amount that can be risked. The trading lot size influences how market movements affect accounts. Let's look at an example. When a 100 pip move occurs, it will not have the same impact on a small trade as a similar 100 pip move on a large trade. As a trader, you will encounter a variety of lot sizes. The lots will be explained as follows. Investing in micro lots. Mini lots are the smallest tradable lots that can be used. A micro lot is 1,000 units of the currency in your account. If you funded your account with USD, a micro lot of that has a value of $1,000 as the base currency. If you decide to trade a dollar-based pair, a pip is equal to 10 cents. As a beginner, it is preferable to use micro lots to reduce risk while trading. Mini lots are made up of 10,000 units of the currency used to fund your account. If you use a dollar-based account as your base currency, each pip in the trade is worth around $1. You should be adequately capitalized as a beginner who wants to start with mini lots. $1 per pip may appear insignificant, but the market can reach 100 pips per day. This can happen in an hour at times. If the Forex market isn't moving in your favor, you've lost $100. It is up to you to determine your ultimate risk tolerance. Before you can trade on a mini account, you should have at least $2,000 in your account, making use of standard lots. In a trading account, a standard lot consists of 100,000 units of the base currency. This is a $100,000 lot if you have a base currency of dollars. The standard pip size for a standard lot is $10 per pip. When the trade goes against you by 10 pip, you lose hundreds of dollars. This type of lot is used by institutional accounts. This means that you must have at least $25,000 to be able to execute trades using standard lots. Many Forex traders prefer to trade in micro lots or mini lots. To a novice, this may not appear glamorous, but if you keep the lot size proportional to the size of your account, your trading capital will be preserved, and you will be able to trade with it for a long time. Let's look at an example. Using a small trade size in comparison to what you have in your account is analogous to walking on a strong bridge with a shelter to keep any problems at bay. It doesn't matter if it rains heavily, you'll be safe. When you place a large trade size in comparison to the account funds, it's like walking on a narrow bridge. In this case, the bridge is brittle and narrow, which means you could fall. A small movement in the market can toss you off course and lead you to a point from which you cannot return. Before you begin, consider the following points. Don't let your profit turn into a loss. Many Forex traders, it has been observed, tends to turn their profit into a loss. The global Forex market is worth at least $5 trillion per day. As a result, it has become the world's most important financial market. The fact that Forex is profitable has made it popular among many traders, from novices to experts, because it is quite simple to get involved in Forex due to the low costs, round-the-clock sessions, and so on. It is also quite simple to lose your capital as you trade Forex. As a Forex trader, you should try to avoid the following mistakes to ensure that your profit does not turn into a loss. Learn, and learn some more. Because it is so simple to get started in Forex, many people have done so without bothering to learn. To be successful in Forex, or any financial market for that matter, you must first learn. You should learn through live trading, experience, and reading Forex literature. Don't forget about the news. You will learn about economic and geopolitical factors that influence a trader's preferred currencies. The Forex market is ever-changing, which means you must stay up to date on changes in regulations, market conditions, and global events. While conducting your research, you should consider developing a trading strategy. This plan should include a method for screening and analyzing investments to determine how much risk to expect when setting investment goals. Only deal with a reputable broker. The truth is that, unlike other markets, the Forex world is not as well regulated, which means you may end up doing business with unscrupulous brokers. If you want your deposits to be safe, you should only open an account with a National Futures Association, NFA, member. You're concerned about the broker's honesty. Use only brokers who are registered as futures commission merchants with your country's regulatory body. Avoid brokers who are not registered. It is also a good idea to research the broker's account offerings, such as commissions, leverage amounts, spreads, account withdrawal, and funding policies, and so on. You can find out more by speaking with a customer service representative. Make use of a practice account. Almost every trading platform offers a demo account. This is also known as a simulated account or a demo account. The account allows traders to conduct hypothetical trades that do not require a funded account. Using a perceived account allows the trader to quickly become acquainted with order entry techniques. Using a practice account allows the trader to learn while also avoiding many mistakes in their trading account. We'd seen cases where a novice trader erroneously adds to a losing position when he meant to close it. Several errors in order entry could lead to a large losing trade. Losing money isn't the only problem. You also have to deal with the stressful and annoying situations. There is nothing wrong with practicing order entries before investing real money in live trading. Maintain the cleanliness of your charts. When a Forex trader opens an account, he or she may be tempted to use every technological evaluation tool available on the trading platform. Many of these indicators are high in the foreign exchange market, but to be efficient, you should reduce the hunger for the analysis methods you use. You are using several similar indicators, such as 3 oscillators or 3 volatility indicators, which may appear unnecessary. You may even receive contradictory signals at times. This is something you should try to avoid. If you're not getting the most out of an analysis technique, consider removing it from your chart. It is also critical to consider the overall appearance of the workspace. The colors, types, and fonts of price hard, such as candle bar, line, range bar, and so on, that you use should create an easy-to-read and interpret chart, allowing you to respond to the market's ever-changing conditions quickly. Stop-loss orders aren't just for avoiding losses. Stop-loss orders are frequently used to prevent losses, but they do more. It can also be used to secure profits. When used for this purpose, it is sometimes referred to as a trailing stop. At this point, the stop-loss order is set at a percentage height that is lower than the current market price and different from the purchase price. The price of the stop-loss fluctuates in the same way that the stock price fluctuates. This means that if the price of a stock rises, you may face an unrealized gain. This means you won't have the funds until after the sales. Using a trailing stop allows you to let your trade run while still ensuring a certain amount of capital gain. It is important to note that the stop-loss order is always a market order, which means it will remain low until the trigger price is reached. This means that the price at which your stock sells may differ from the price you specified as your trigger price. The advantages of a stop-loss order. One thing we all like about stop-loss is that we don't have to pay anything to use it. The standard commission is only charged when you reach your stop-loss price and sell your stock. You should think of it as a free insurance policy. Using a stop-loss ensured that decisions were made based on facts rather than emotion. Many people end up crushing on their stocks, believing that if they allowed the stock to remain on the market, it would undoubtedly succeed even when the facts tell a different story. This causes the trader to delay and procrastinate, and before you know it, he is raking in unimaginable losses. It makes no difference what type of trader you consider yourself to be. There must be a reason you have decided to own a stock. A value investor's criteria are usually different from those of a growth investor and an active trader. Chapter 20. Advanced Strategies. When it comes to capitalizing on small, frequent price movements, day trading strategies are the best option. Any effective strategy you select must be consistent and based on in-depth technical analysis that employs charts, market patterns, and price indicators to forecast future price movements. It is your responsibility to select the most appropriate strategy for your needs. As a trader, you should be aware of the average daily trading volume. Angel who has fallen. A fallen angel strategy involves a bond that has been demoted to junk bond status from investment grade status due to the issuer's deteriorating financial condition. In the stock market, a fallen angel is a stock that has always been high, but has now dropped significantly. A fallen angel bond is a sovereign, corporate, or municipal debt that has been downgraded by a rating agency. The primary reason for such downgrades could be attributed to revenue decline, which generally jeopardizes issuers' ability to service debt. When expanding debts are combined with expanding debt levels, the potential for downgrade often skyrockets. The securities of fallen angels can be very appealing at times, especially to contrarian investors looking to capitalize on the potential. As a result, the issuer can recover from the temporary setback. For example, an oil company has reported sustained losses due to falling oil prices over several quarters. As a result of the increasing risk of default, the company may decide to downgrade its investment-grade bonds to junk status. This will result in a drop in the price of the company's bonds as well as an increase in yields, attracting contrarian investors who see low oil prices as a temporary condition. However, there are some circumstances in which you are likely to lose money, particularly if the fallen angel bond issuers do not recover. For example, if a competitor company introduces superior products, the issuers may be unable to recover. Reverse ABCD pattern ABCD sequence. The ABCD pattern is a pattern that demonstrates perfect price and time harmony. The ABCD pattern typically reflects the market's common and rhythmic style. The geometric price-time pattern is made up of 3 consecutive price trends with a leading indicator that can help a trader decide when and where to enter and exit a trade. As a trader, the ABCD pattern can be very useful in identifying available trading opportunities in any market, futures, forex, or stocks, on any time frame position, intraday or swing, and in any market condition, range-bound, bullish or bearish markets. ABCD pattern can help you determine the reward and risk of a trade before you place it. Figure 1. An illustration of the ABCD pattern, above. Figure 2 shows an ABCD pattern on a trading chart. The bull flag and the bear flag. A flag in technical analysis refers to a price pattern that can explode and move within a shorter time frame than the prevailing price trend that has always been observed on a price chart in longer time frames. A trader can identify the possible prevailing trend that is continuing from a given point where the price has drifted against the same trend using flag patterns. As a result, if the trend resumes, noticing the flag pattern will result in a rapid price increase, making the timing of a trade advantageous. Flags are areas of tight price consolidation that show a counter-trend sharp directional movement in price. This pattern consists of 5 to 20 price bars. Formation of a bullish flag. These are formation patterns that can be seen in stocks that are on a strong uptrend. Bull flags got their name from the pattern's resemblance to a flag on a pole. A pole is formed by a vertical rise in stock, and a flag is formed by a period of consolidation. The flag is usually angled down, away from the current trend, but it can also be a horizontal rectangle. The bullish flag pattern begins with a strong, almost vertical price spike. Prices then peak and form an orderly pullback in which the lows and highs become almost parallel to each other, forming a tilted rectangle. Figure 3. Formation of a bullish flag. The plotted trend lines reflect the parallel diagonal nature, both lower and upper trend lines. The first breakout occurs when the upper resistance trend line is broken. Another uptrend move and a breakout are formed when prices explode, causing prices to surge back towards the formation's high. The bearish flag. This flag is an upside-down version of the bull flag when compared to the bull flag. The bearish flag is the inverse of the bull flag. In this case, the flagpole forms an almost vertical panic price drop because the sellers catch the bulls off guard, resulting in a bounce with parallel lower and upper trend lines, forming the flag. When the lower trend lines are broken, panic sellers are triggered. This flag is similar to the bull flag in that the strength of the bear flag is determined by the severity of the drop on the flagpole. Figure 4 depicts a bearish flag. Improve your trading skills. To become a trader, you must be knowledgeable in not only finance or business, but also hard science or mathematics. You must be able to conduct in-depth research and analysis that reflects economic factors from a broader perspective, as well as day-to-day chart patterns affecting various financial markets. As a trader, you must sharpen your ability to concentrate and focus, especially in a fast-paced environment full of people with diverse goals and ideas. You must also be able to maintain self-control and regulate your emotions even when confronted with upsetting situations. Finally, you should always be able to keep an accurate record of your trades, to keep an eye on your account, and provide you with a learning opportunity that will help you become a better trader. Chapter 21. Rules of Day Trading. Let us now look at some of the day trading rules that every investor should follow. These rules are not always unbreakable. You can choose to follow or ignore these rules as you embark on your investing journey. They should, however, be followed to provide you with the best day trading experience possible from the start of your investing career. Day trading is a serious endeavor. When some people first start day trading, they believe it is all for fun and games, and they do not take the profession seriously. This could be a fatal error. While it is important to enjoy what you are doing, it is also important to remember that it is a serious business. Some types of investing are easier to manage as a side job or on the weekends. If this is the type of investment you are looking for, you should avoid day trading. This type of investing is intended to be a day-to-day business, and many people consider it their day job. This means that if you decide to become a day trader on a formal basis, you must approach it in the same way you would any other career. You must get up in the morning, prepare for your day, and ensure that you are ready to work by your assigned time, which could be as early as 7 a.m. While you will have some schedule flexibility from your regular job, which means you can set a later start time in the morning, you will want to make sure to set a schedule that you will follow at least Monday through Friday. Even if you work from home, you should keep distractions to a minimum. You wouldn't want to be focusing on day trading and watching television at the same time. For example, set up an office for yourself and focus on your work. Prepare for your job as a day trader in the same way you would for any other office job. You should not come to work in your pajamas. If you approach this as a career, you are more likely to feel compelled to give it your all and succeed. Day trading will not help you become wealthy quickly. Day trading should not be viewed as a get-rich-quick scheme. This is a common misconception, and it is one of the reasons why people turn to day trading. If you truly want to be a successful day trader, you must have the patience to build your investments as well as the understanding that it takes time. Day trading is more difficult than it appears. Day trading is not as simple as it appears, but that does not mean you should put this book aside and decide not to become a day trader. It simply means that you will need to devote more time to learning about day trading than you anticipated. Before you make your first investment, you should ensure that you are well versed in the field. Fortunately for you, this is one of the reasons I decided to write this book in the first place. I want to give you a comprehensive beginner's guide so you can learn everything you can about day trading in one place. In other words, I've done the majority of the legwork for you. Trading is not the same as investing. One of the most important rules to understand before becoming a day trader is that it is not the same as investing. To help you understand the distinction, here are a few key distinctions between trading and investing. As an investor, you need to know where the stock market is going in the future. However, as a day trader, you only need to be concerned with which stocks will provide you with the greatest financial gain on that particular day. You examine the minutes more closely. You won't even notice the time and won't be concerned about the next day, week, month, or year. You are not going to win every trade. No matter how experienced you become as a day trader, you will still have days when you lose a trade. Many people imagine themselves becoming so skilled at trading that they will never make a mistake and will only make money. Every game has its own set of rules and regulations, and day trading is no exception. If you are new to the game, you must remember all of the standard rules that have been put in place to keep the game under control. That being said, it is important to note that these rules are not infallible, but they can be useful in making day trading decisions. There are numerous day trading rules that you must learn. Regardless of whether you specialize in forex, stocks, options, cryptocurrency, or futures, failure to follow some of the rules can result in significant losses. While some rules vary depending on where you live and the size of your business, this chapter will focus on the most important ones. Furthermore, it will go over the rules that novices can follow as they enter the complicated world of day trading. These rules will also help experienced traders improve their trading performance. For example, in the area of risk management. Beginner's rules. If you are new to this field, the day trading rules discussed below can help you reap commendable profits while avoiding significant losses. Enter, exit, and escape. One common mistake that newcomers make is entering the arena without a well-thought-out game plan. Do not dare to press the enter button unless you have a plan for getting in and out. When you are new to a field, it is natural to feel a sense of excitement. It is important to note, however, that if you do not have a formidable plan, you will be eliminated from the game. Use risk management rules as well as stop-loss orders to reduce losses. Timing. I'm sure you usually get up bright and early ready to face the day trading arena. However, avoiding the first quarter hour after the market opens is arguably one of the most important trading rules to follow. The majority of the activity at this time involves market orders or panic trades from the previous night. Instead, you should use this time to monitor for reversals. The first quarter hour is also avoided by the most experienced day traders. Be aware of margin. Do you remember when you were starting and looking for capital? It was very easy to get caught up in the margin. However, keep in mind that this is a loan that must be paid back. While it has the potential to significantly boost your profits, it also has the potential to leave you nursing significant losses. As a result, before using margin, it is best to learn how to trade properly. Accounts for practice. You have a lot to learn and nothing to lose by taking the initiative to start with a demo account. Because you are being funded by simulated money, you can nurture your craft with plenty of time and space for trial and error. Many brokers will provide you with free practice accounts because they are the best place to learn about strategies, patterns, and charts, as well as the quarter-hour day trading practice. Recognize and accept your loss. Almost all the veteran traders have achieved their success because they were willing to lose and learn from their mistakes. Accept that losing is merely a means of gaining more experience. That being said, it is also critical to emphasize the importance of cutting your losses. Observe everything. A veteran once said that a great trader is similar to an athlete in that he may have the skills, but he must train himself on how to use them. Complacency should not be something that great traders associate with because it is something that they should always be. I am looking for that edge. This means they use a variety of resources to expand their knowledge. They can make use of anything, including videos, books, blogs, and forums. Perform a tip evaluation. It's natural to get excited when you're given a thought-provoking tip. Nonetheless, unconfirmed tips from untrustworthy sources can result in significant losses. Jesse Livermore, a trader, claims that experience has taught him a tip or a series of tips that will make him more money than his judgment. As a result, double-check any information that may influence your trading decisions. Risk management guidelines. The rules of money management and the risks of day trading are important factors in determining a trader's success. Although you are not required to follow these rules to the letter, they have proven to be invaluable to many. The 1% rule of risk. The goal here is to prevent you from trading beyond your skill level. When you use this technique, whether you have a trade subsidy or not, you will always have some reserve. I have money in the bank to assist you in correcting your balance later on. The idea is that you should never trade with more than 1% of your total account on a single trade. For example, if you have $50,000 in your account, you will only use $500 on your trade. Why should you use it? To completely clear your bank account balance, you must lose over 100 trades at the same time. This is important to protect your earnings when market conditions are volatile while also earning good returns. I'm sure you're concerned that if you trade so sparingly, you won't be able to maximize your profits. Don't worry, you can make a lot of money. If you stake 1%, you should expect a profit of 1.5% to 2%. Profits will undoubtedly become apparent if you trade several times per day. It is arguably the best approach for those who are just getting started. Losses can come fast and thick, no matter how much you learn through trial and error. However, if you are consistent, it will teach you the game's tricks until you become a trading veteran with an arsenal of techniques for making maximum profits in daily training. Variations. Once you've developed an effective technique, you can adjust your risk tolerance. You can increase it to 1.5 or 2%. It is important to note, however, that traders with $100,000 in their accounts should not risk more than 1% in a single trade, because even a 1% loss can have a significant impact. Essentially, it is about finding an area that you are comfortable with and that also corresponds to your trade style. Chapter 22. Steps to Success on Trading. A higher percentage of day traders fail as a result of ignoring critical steps. If you've decided to do day trading, there are a few steps you should take to maximize your profits. Make a trading strategy. A trading plan is a set of guidelines that most traders must follow to guide their activities. A trading plan will assist you in proper money management to avoid losses. Before implementing a trading strategy, you should backtest it to ensure that it produces positive results. The majority of trading brokers include backtesting tools in their software. A working and affirmative trading plan will guide you on how to do things correctly to succeed. Decide on an entry and exit price. To survive in this game, you must understand both the entry and exit prices. Worst-case scenarios exist in day trading, just as they do in any other business. The entry price will help you understand when to enter, whereas the exit point will help you understand when to exit. With the prices, you will be able to plan how to handle things in the event of a market disaster with no worries. When the market opens, do not rush to trade. Make a trading schedule for yourself. Do not rush to trade as soon as the market opens. These are risky times because trades may occur during the night, and the market is not stable at that time. You should be aware of the best time to execute your transaction. Different market securities trade at different times. Don't get too excited and do things rashly. Make a timetable for your trades. Limit orders are available. Limit orders are highly recommended in trading. What exactly is a limit order? It is a trading order that allows you to make sales and purchases in the market at a specific price. Limit orders as opposed to market orders, allow you to specify both the maximum price you will pay and the minimum amount you will sell. A market order allows traders to buy or sell orders at the market's current prices. A market order is usually more concerned with the execution of the order than with the price. Unlike a limit order, it will execute the order at the current market price. A limit order verifies the amount and ensures that it falls within the parameters of the limit order. If it does not fit within the parameters, no trades will be executed. Avoidance of losses. Losses are unavoidable in any business, but do your best to avoid them. Small losses aren't always a big deal, but keep an eye out for losses that aren't continuous. You could fail miserably. Be self-disciplined and stick to your trading plan. Recognize and correct the errors that lead to failures. If you're still losing money despite sticking to your trading plan, change your strategies as soon as possible or quit trading. To be successful in trading, you must limit your losses, which reduces your profits. Accept setbacks. Trading losses are a necessary part of the learning process. When losses occur in trading, do not panic. Instead, accept them. Learn from your mistakes and come up with a solution. Don't be depressed or anything. Even professional traders have suffered losses and recovered. Utilize technology. Day trading is all about competition. To achieve a high level of performance, you should use efficient methods or techniques. Some of the methods can be implemented through the use of modern trading technology tools. Simple charting platforms and backtesting tools are examples of technology tools. The majority of charting platforms have simple user interface features that make it easier to read market prices. Backtesting tools also assist traders in testing their trading plans and strategies for improved trading performance. Technology expedites trading transactions and allows you to stay current. Staying current keeps you informed of market changes such as price fluctuations. Maintain concentration. Being a focused and self-disciplined trader will save you a lot of time and money. If you want to be successful, you must first gather your resources and develop strategies and plans for trading. Know when it is appropriate to make trades so that you do not miss out on the best time to make your trades. A schedule will help you stay organized and manageable. This rule must be followed to be successful in day trading. Use money you can afford to lose when trading. The risks associated with day trading are enormous. The money used for day trading should not be capital or savings, which are important aspects of any business. You should instead trade with cash specifically for trading, which will not be a problem if you lose it and can be recovered quickly. Do not ever consider trading with your child's school fees. You will be in big trouble. Take charge of your risks. You must have strategies in place to manage your trading risks. Do not ignore them unless you want to be a trading failure. Be aware of the risks, or your day trading will spiral out of control. Make trades following your trading plan and strategies, and you will succeed. Maintain a growth mindset. To be successful at day trading, you must have a growth mindset. After starting day trading, most traders have the mindset that they will make a lot of money all at once. Rushing for massive benefits when you aren't even stable will cause you a lot of stress. Relax. Everything will work out in the end. Do the right thing at the right time, and everything will fall into place. Avoid making use of margins. Margins allow you to leverage your funds as well as extra cash borrowed from brokers. It can also help you borrow more money. Trading on margins can be risky at times. In the market, margins can rise or fall. The major risk in margins is the large loss that occurs when the margin falls. It aggravates the situation when you lose the borrowed funds. Set lofty objectives. You must set high standards for yourself. Goals will help you work towards something you need to accomplish. Visualize your goals clearly and day trade toward them. You will succeed in day trading if you work hard. Maintain a business mindset. Businesses are involved in almost everything. Profits, losses, expenses, risks, stress, and so much more are all part of it. Normally, it is highly recommended that in-depth research about your business be conducted and good strategies are laid out to improve the business's potential. This is similar to day trading in that you must lay out a good plan with specific strategies and learn more about your day-to-day trading occurrences to excel and acquire large chunks of profits. A marketer's apprentice. Trading markets are extremely volatile. As a trader, you should learn as much as possible about what used to happen, what is happening, and all of the facts involved in day trading. This increases your level of knowledge and education, as well as your ability to manage risks. With all of these outcomes, day trading becomes much easier, and the chances of incurring day-to-day losses are reduced. Creating and applying the trading methodology. A day trading methodology is a set of methods that are laid out so that traders can use them in their day-to-day trading activities. This reduces the hesitancy that is commonly experienced by most traders who simply try their luck during trading without a plan and hope for the best. Day trading is not a get-rich-quick type of activity, but rather one that necessitates intelligence and a variety of tactical abilities. Stop losses are frequently used. A stop loss is simply the amount of risk that a day trader is willing to accept with each trade. It is typically in the form of a percentage or a specific trading amount that limits the trader's exposure during trading. Above all, using stop losses ensures that risks and losses are kept to a minimum. Knowing when to put your money on the line. There are two reasons why you should probably stop trading: an ineffective trading plan and an ineffective day trader. Major losses are expected in an ineffective trading plan, most likely because markets have changed, market volatility has decreased, or the trading plan is simply not working as expected. This does not necessarily imply that trading must be discontinued, but rather that a new trading plan and strong trading strategies must be established. An ineffective day trader, on the other hand, is an unwelcome day trader. There must be a rule to excel in day trading. Be disciplined. Follow your big plan. Work hard and learn. Be patient, and so on. If this does not completely define you, then day trading is probably not your type of activity. Maintain your trading perspective. During trading, it is best to keep the big picture in mind. Setting attainable goals is one way to keep trading in perspective. For example, if a trader has a small trading account, he or she should not expect to make large profits. Always work with what you have on your plate and try to stay as rational as possible. It is a step-by-step income-generating activity that necessitates a great deal of patience and a wide range of day trading skills. Also, winning and losing in day trading will be fairly common occurrences. When you win, enjoy and celebrate your good efforts, but don't lose too much control. When you lose, remember that losing trade is not far away. Maintain your focus and stay put. Trading is not a recreational activity. Most traders, especially beginners, have misunderstood the term. The novice should understand that day trading is both an income-generating and capital-depleting activity. Keep in mind that failing to plan is planning to fail. Plan your strategies, learn, and make your day trading journey a success with only a few losses. Discover how to trade options. When trading options, a trader must wait 1 day for the money to settle after a trade. T+1 are the day trading options rules. Read several blogs describing these, preferably those that are not overly advanced, to avoid making it difficult to implement a variety of strategies in the early stages of trading. Chapter 23. Average income of a day trader. You can go to a dependable gauge of what an informal investor can make based on their location, starting capital, and business status. Let's face it, a sizable number of people are considering going out without anyone else and are not looking for a new line of work. Anyone who tells you a definitive range for a day exchanging pay is most likely deceiving you. I might as well have been talking to one of my kids about Yagaba, one of their favorite Nickelodeon shows. The reason for this is that numerous outside variables influence how much money you can make. In this article, we will sift through all the lighting on the internet and get down to cold, hard facts. Sit back, relax, and order an espresso. This is not a decision to be taken lightly. You should not take this decision lightly, and you should weigh the benefits and drawbacks. To begin with, exchanging for another person will allow you to use the tools and systems of a more advantageous outfit. A portion of the advantages of exchanging for another person is the weight of recognizing both a victorious framework and a tutor who can help you en route. It is on the off chance that you are not beneficial enough. Prepare to have more rules thrown at you than when you were in 6th grade. This level of control over your trading action is because you are utilizing another person's money, so profit or become accustomed to someone showing you how to unwind. The one significant advantage of day exchanging for another person is that you will be paid. This pay is probably insufficient to live on, but you do get a check. There is no pay when you go out on your own. You are a financial expert who needs to make payments. We will delve much deeper into this topic. Later on, however, I needed to make certain that I stated this clearly. Licenses. If you choose to work for the firm and are exchanging customer funds or possibly interacting with clients, you will require your Series 7 and possibly your Series 63 permit. 7th arrangement. Series 7 will permit you to exchange. The last time I checked, the test was $305, and the outfit was secured by the firm. Arrangement No. 63. After passing Series 7, you should take Series 63. This test allows you to request stock orders while in a point of view state. The 7 gives you the ability to exchange on a government level, while the 63 allows you to work within the confines of state laws. I don't plan on covering the topic of day exchanging for someone, finally because I haven't experienced it. According to what I know, you must complete some in-house preparation programs for the firm with which you speak. For venture firms, you'll get a decent starting salary, enough to keep you in the lower white-collar class in New York. Discover the best part. In the United States, your base stock merchant pay could range from $50,000 to $70,000, which is only enough to cover your link tab, feed yourself, and perhaps take a taxi or two. In any case, this does not cover meals, transportation, excursions, tuition-based schools, and so on. As a result, I believe you can quickly see that to be fruitful, you'll need to make your reward. There is only one catch. You must profit from day trading. On the surface, this appears to be a good idea because you reduce your risk profile by having another pay stream of a base compensation. However, you need to perform to stay employed and will only get around 10 to 30% of the benefits you get from your trading movement. Based on these figures, you'd need to make around $300,000 in exchange for benefits to break even on a $100,000 salary. Most likely, the advantage of exchanging with a business is that your purchasing power will grow over time, and you won't face any disadvantages because it's the business's money. The key is to have a large amount of money under administration. As shown in the infographic above, the first step toward making real money is to begin dealing with various assets. You will, in some way, draw that off, and you will make, on average, $576K per year. Yes, you read that correctly. I realize the $576K looks appealing. However, keep in mind that getting to the mountain's highest point is pure hard work. Another point to take away from the infographic is that the standard reward is starting to rise and, if all goes well, will surpass the downturn peak not long from now. As a result, if profit is one of your goals, you've come to the right place. Trading for a living. Individuals with a broad appeal can expect to earn between $100,000 and $175,000. Finally, if you are below average, you should expect to be given a pink slip. In any case, take a breather. There's more. Certainty If we extend our search beyond New York, we will discover that the average pay for a merchant is $89,496. Open trading firms. However, numerous jobs pay close to $89,000 and don't necessitate the level of responsibility and risk-taking required for exchanging. This person just revealed to me it could go as high as $250,000 to $500,000 if I'm better than expected. Where $89,000 becomes an integral factor, you may be thinking, so far, I've discussed the pay rates for traded on an open market organization Good Karma for attempting to obtain precise information for the first-class universe of private value brokers. What you will discover is that top brokers from Chase and Bank of America frequently venture out to flexible investments because of the opportunity in their exchanging choices and the higher compensation potential. The most important part is that, in general, for population firms, corporate objectives will frequently drive a portion of your other targets. The beauty of the multifaceted investment world is that, while there are still organizational goals, you have the opportunity to eat a larger portion of what you slaughter. It's nothing for a top broker to out-acquire their boss if they bring enough incentive to the firm. What do you think you could earn? The following are the benefits of day trading for a business. Pay. Advantages in medicine. Working for a venture bank or making fence investments has earned you a reputation. There is no risk to individual capital. Climb the corporate ladder to deal with a variety of assets. A disadvantage of day trading for a company. Customers must be contacted. Legislative issues in the office. In general, you receive 20% of the benefits. Public firm. Day trading for a property management company. Day trading for real estate firms can feel a lot like living on the edge. You will be given some training, similar to when exchanging for a company before the prop firm allows you to trade with their money and approach their frameworks. From then on, all parallels between exchanging for a prop firm and an organization contrast. Try not to expect any paid human services or downtime. There will be no base pay or yearly audits. To begin using their foundation, the prop firms will expect you to save money. The benefits are that the prop firm will split the profits with you anywhere from a third to half. The disadvantages are, once again, no compensation and you bear a portion of the torment in terms of misfortunes. However, here's the catch. The reason prop firm merchants don't make the same excuse as speculation houses is a lack of capital. Because you are most likely exchanging the sole proprietor's cash, the pool of assets you approach is limited. I would estimate that a better-than-expected broker for a real estate firm can earn between $150,001 and $250,001 per year. The average broker will do between $60K and $100K. And underperformers will have so many position limits set for them that they are fundamentally rehearsing rather than profiting. Because rehearsing does not take care of the tabs, these underperformers will most likely be kicked out of the game. Advantages. Benefits are shared with the prop firm. Commissions are kept low. There is no boss increment margin. Start with your cash flow. Individual wealth loss. Preparation time constraints. There are no medical benefits or paid time off. There is no vocation movement. Simply make money off what you want to buy. Day trading wages state by the state in the United States. Regardless of the information shown in the infographic from the Office of the New York State Comptroller, I needed to go a step further to distinguish the starting pay for a passage level exchanging work across the country. I determined a passage level to provide a counter to the middle national average of $89,000 for an exchanging job. Keep in mind that $89,000 is typical of junior exchanging jobs, up to the most senior. As a result, if you are just starting and are offered $50,000, you should not be discouraged. We must begin somewhere as a group. The New England and Pacific regions of the country, as expected, have the highest pay. At the moment, these can simply be attributed to the standard average cost of essential items. However, You can learn about your state to determine how much money you can expect to make as a less experienced dealer. The legend. Many online articles are explicit about the benefit proportion you can expect if you become an informal investor. For example, an article by Corey Mitchell that appears on the Vantage Point trading website explains it in detail and expects to begin exchanging capital of $30,000. Accept your usual 5 exchanges per day. So if you have 20 exchanging days per month, you will make 100 exchanges per month. You make $3,750, but you have commissions and possibly other charges on top of that. The cost of each contract exchange is $5. Full circle. Your bonus expenses are as follows. 100 exchanges multiplied by $5 multiplied by 2 agreements equals $1,000. Mitchell's model calculates your net after bonuses to be $2,750. Since you started with $30,000, that is a monthly return of slightly more than 9%. If you reinvest those profits every month, at the end of 1 year, you will have an interest of $55,944 and change. It's not bad, and the best part is that you don't have to get dressed for work. Chapter 24. Common pitfalls you can avoid when day trading. There are some basic tenets of day trading that you must follow regardless of which strategy you use, which market you participate in, or which assets you choose to trade. When day traders fail, it is usually because they fell into some very common and easily avoidable traps. Before you even begin your trading career, take a look at these mistakes and make sure you're protecting yourself from them as you create your trading plan. Starting large. As a new day trader, you're probably giddy with excitement as you prepare to begin your trades. You've studied all of the theory, including the tips and tricks, and believe you're ready for the game. If you have managed a sizable capital portfolio as a result of an investment, you may be eager to start large and make big profits. Learn the fundamentals. Day trading is not something you can simply teach yourself and then excel at. You need to get some hands-on advice from experienced day traders. To accomplish this, locate an experienced trader and spend some time observing them, asking questions and listening to advise. Learn how to play the game of trading to gain the confidence to try it yourself. Recognize that this will necessitate patience on your part to be completed correctly. With the right determination, you'll discover that your efforts are sufficient to result in large profits. Preparing to fail. Day traders, in particular, should plan to fail rather than fail to plan. Trading is about making money, not about feeling exhilarated by taking risks with your money. Given the expected outcome, all traders must have a plan of action. Because of the speed and emotion that characterize day trading, a plan is especially valuable. Day traders are likely to be backed into corners where they must make instant decisions, or during a volatile day of trading, they may become engrossed in the events of the day and make decisions that will harm their bottom line. Having a plan in place, especially one that is written down, is an important step toward controlling day trading. Discipline is lacking. Stop-loss orders are an example of discipline. These orders are triggered in the day trading market based on certain conditions. They assist investors in saving money, especially when the trade is automated. All traders must have a plan in place to help them manage their risks, as well as their chances of success or failure. Control your expectations. Day trading is not a quick money scheme. It's also not a magic wand that will solve all of your problems. It's difficult, and there's always the risk of losing everything. Rather than expecting to make a fortune, expect to put in a significant amount of effort to perfect your trading method. This is because trading success necessitates extensive planning as well as hard work. Keeping yourself too busy. Being busy is good, and many people want to be perceived as being busy because it validates the amount of work that they have had to do. Being overly busy in trading is not good for a trader. It alludes to the possibility of allowing things to slip through their fingers. A novice trader may attempt to manage at least 10 trades in a single day. The assumption is that by trading more, you will make more money. This may or may not be the case. Some professional traders insist on only making 2 trades per day. They may complete the trades early in the day, but the rest of the day can be spent following up. It is easier to detect market changes when there are fewer day trades to monitor. Keep an eye out for losing streaks. Nothing is more disheartening than losing money consistently when day trading. If you're not careful, you could end up clinically depressed, especially if you're constantly losing more progressively. That is why, even if you have the desire to day trade on your own, you should seek the advice of a successful professional. You will eventually grow out of the phase of losing streaks, and the times when you were demoralized will be distant memories, thinking that anyone could do it. Would you let a high school student operate on you if you were in a car accident and needed life-saving surgery? Not, is most likely your response. Would you give a large sum of money to the first person you see on the street and say, "I'll wait to hear from you if you had a large sum of money that you wanted to see grow"? Of course, this is extremely unlikely. Maintain a close eye on your risk capital. Your trading capital is the amount of money you are willing to put at risk. This is money that should be dedicated solely to day trading and nothing else. If you lose everything, your life will not fall apart around you. It's also worth noting that a day trader is required to maintain a certain amount in their account as equity, and the minimum must be maintained if any day trading is to take place. Making a mistake with your margin. As a day trader, your capital is likely to fluctuate up and down throughout the day. Sometimes it's a little low, and you need a little boost. So, you decide to borrow from a broker to purchase securities. If used correctly, this is intended to be a facility that gives day traders some wiggle room, even though some people have abused or misused this assistance. This can happen when a person borrows far more than they can afford to repay, resulting in an empty trading account and mounting debt. For as long as possible, day traders should trade within their means, ignoring critical resources. An excellent high-speed internet connection is possibly the most valuable asset you can obtain that will lead to success when day trading online. The next step is to invest in cutting-edge software that is specialized and fully loaded with a variety of analysis tools. Then, make sure your trading wallet is fully stocked, as you will need a significant amount of capital to get started. You should have direct access to an expert in the field as part of your resources so that you can get advice when you need it and input on your equipment and its specifications. Finally, hire a coach for yourself. This will be an excellent investment because it will allow you to learn everything you need to know to master day trading in the long run. Having forgotten about mental health, having the right mindset can mean the difference between winning and losing. To emerge as a winner, one who is competent and can trade on instinct, you must learn how to manage your emotions. As a result, you cannot let the intense thinking and mental energy required for day trading bring you down and drain your energy. You must be prepared to take action. This is analogous to having a jerk reflex. You will be able to gain competence and win consistently if you have this trick up your sleeve. It will strengthen your intuition, allowing you to always aim for and achieve trading success. Inadequate education and research. The first mistake that newcomers frequently make is a lack of understanding of the markets. Before you pull out your wallet or credit card, make sure you understand the fundamentals. That includes understanding what all of the index funds mean, as well as some basic stock market jargon and understanding the various ways to buy stock. It's also critical to understand the markets on a deeper level. Allowing emotions to take precedence over facts decisions must be governed. Emotions have a nasty habit of infiltrating stock market investing. It's thrilling, but it can also be terrifying if you're about to lose your shirt. The real issue, of course, is that people overestimate the dangers. Inadequate planning. Beginners frequently make the mistake of not planning their trades. To become an experienced trader, you must work hard. You can't make up a mental map of how you think you'll carry on the business. Proper working and research are required. You should make a list of the risks, potential gains, and cost-to-revenue ratios. Lack of current technology day trading is a game of inches, and the changes that can occur in the blink of an eye can be enough to make or break the success streak that you have been courting all day. Remember that even if you believe the technology you are using to trade is adequate, you are competing with other traders, both large and small, who are all attempting to outperform one another with the best technology on the market today. While this does not necessitate the purchase of a $3,000 computer, it does imply that you will need a rig capable of competing with the current generation of hardware if you hope to make the kinds of split-second trades that result in long-term profit. Arriving at the wrong time. It can be difficult to get your bearings when you first start, which means that when you do come across a specific trend, it can be easy to jump on it now and ask questions about it later. While this may result in success from time to time, the fact remains that spotting a trend at the right time is far superior to spotting it in the first place. The most profitable time to spot a trend is when it is just getting started. This way, you will have a good time frame to profit as it matures. It will help to have an idea of who the major players are in the types of stocks that you prefer when it comes to spotting trends early. Big-time players are the ones whose movement alone is enough to change the state of the market, and getting to know them and keeping a close eye on them is critical to your long-term success as a day trader. Not balancing research with current reality. There are two types of new day traders: those who do too much research before starting and those who do not do enough research before starting. Those who conduct excessive research tend to consider every aspect of the companies in which they are considering investing, and only invest when the fundamentals appear to be completely on the up and up. Day trading should not be regarded as a job. If you ever want to day trade full-time, the first thing you must do is treat trading as if it were a job. This entails committing to it for the same amount of time every day, regardless of the circumstances. If day trading is a job, it means you are your boss, which means you must keep track of your comings and goings and ensure you devote the necessary time to trading each day to meet your objectives. Chapter 25. Common day trading mistakes to avoid. To succeed as a day trader, you must not only do the right things but also refrain from doing certain things. The following are some of the most common day trading mistakes to avoid. Day trading excessive. Excessive trading refers to the execution of too many day trades. One of the most common mistakes that newbie day traders make is believing that they can become day trading ninjas in a matter of weeks if they trade frequently enough. However, while more practice can eventually translate into day trading mastery in the future, it does not mean that you can cram all that practice into a very short period by day trading frequently. The adage, the more, the merrier, does not always apply to day trading. Remember that timing is everything when it comes to day trading, and timing is determined by how the market performs during the day. There will be days when day trading opportunities are scarce, and days when day trading opportunities abound. Don't force trades just to get enough day trades under your belt, even amid a plethora of profitable day trading opportunities. The adage, the more the merrier, does not apply. Why? If you're a new trader, your best bet or becoming a day trading ninja as soon as possible is to limit yourself to 1 or 2 day trades per day. By limiting your day trades to 1 or 2, you will be able to closely monitor and learn from your trades. Can you imagine executing 5 or more trades per day as a beginner and monitoring all of those positions at the same time? You'll only become confused and overwhelmed, and worse, you may miss day trading triggers and signals, causing you to lose money. Taking a chance. If you want to be a successful day trader, you must respect and value each trading day. Instead of winging it, plan your day trading strategies for the day and execute them. As corny as it may sound, failing to plan is planning to fail. And, given the financial stakes involved in day trading, you should not go through your trading days without a strategy in place. Lady Luck favors those who are prepared, and planning can persuade her that you are. Too much expectation, too soon. Day trading is, without a doubt, one of the most exhilarating jobs in the world. And the stories that many day traders tell about the riches they have amassed through this economic activity add to the excitement, desire, and urgency for many to get involved. Too much excitement and desire, however, as a result of many day trading success stories, can be very detrimental to newbie day traders. Let me correct myself. It is harmful to inexperienced day traders. Why? Such stories, many of which are likely urban legends, instill unrealistic expectations of quick and easy day trading riches in newcomers. Many new day traders believe that day trading is a get-rich-quick scheme. It isn't. Many day traders don't brag about the times they lost money or how long it took them to master the craft enough to quit their jobs and do it full-time. Even rarer are stories of the countless people who have tried and failed at day trading. The scarcity of such stories tends to instill unrealistic expectations in newcomers to day trading. What's the problem with having unrealistic day trading expectations? The problem is that if you have very unrealistic expectations, you will almost certainly fail. It's because unrealistic expectations can't be met, and thus there's no chance of success. One of the most unrealistic expectations associated with day trading is the ability to double one's initial trading capital in a couple of months at most. Similar to such expectations is the ability to quit one's day job and live a prosperous life in just a few months through day trading. Successful day traders experienced numerous failures before they were able to make a living from day trading. If you decide to try your hand at day trading, set realistic goals. Don't expect to profit anytime soon. Instead, accept the first losses as they come, limiting them with sensible stop-loss limits and learning from them. You'll eventually get the hang of it, and your day trading profits will begin to outnumber your day trading losses. Frequently changing strategies. How well do you know how to ride a bike? If you don't, do you know anyone who does? Learning to ride a bike, whether for yourself or someone you know, does not happen overnight. It took time, as well as a few falls and bruises along the way. Despite falls, scratches, and bruises, you or someone you know persisted in learning how to ride a bike and, with enough time and practice, succeeded. It was because you or the other person understood that initial failures meant riding a bike was impossible. It's just difficult at first. It's the same as learning how to profitably day trade. You'll need to put in the time and practice to master it. Just because you lost money in the beginning doesn't mean it's not working or isn't for you. It most likely means you haven't mastered it yet. However, if you quit and quickly switch to a new trading strategy or plan, you'll have to start over, extend your learning time, and possibly lose more money than if you stuck with your initial strategy long enough to give yourself a chance at day trading successfully or concluding with certainty that it's not working for you. If you change your day trading strategies frequently, i.e., if you don't give yourself enough time to learn day trading strategies, your chances of mastering them decrease dramatically. In that case, your chances of success in day trading are significantly reduced. Not examining previous trades. Those who do not learn history are doomed to repeat it, wrote philosopher and writer George Santayana. We can paraphrase it to say, those who do not learn from their day trading mistakes will be doomed to repeat them. You'll be doomed to repeat your losing day trades if you don't keep a day trading journal with records of all your trades and, more importantly, analyze them. It's because if you don't, you won't be able to figure out what you're doing wrong and what you should be doing instead to have more profitable day trades than losing ones. Another saying goes, if you always do the same thing, you'll always get the same result. Unless you analyze your previous day's trades regularly, you'll keep making the same mistakes and losing money. Getting rid of correlations. Correlations are defined as relationships in which one thing influences the outcome or behavior of another. A positive correlation indicates that both tend to move in the same direction or exhibit similar behaviors, i.e., when one rises, the other rises as well. And vice versa, the stock market is rife with correlations. For example, stock market returns are typically negatively correlated with Federal Reserve interest rates, i.e., when the Feds raise interest rates, stock market returns fall, and vice versa. Correlations exist in the stock market across industries as well. Property development stocks, for example, are positively correlated with steel and cement manufacturing stocks. This is because when property development is booming, it purchases more steel and cement from manufacturing companies, increasing its income. Ignoring correlations during day trading increases your chances of taking and exiting incorrect positions. If you take a short position in a steel manufacturer's stock while taking a long position in a property development company's stock, one of those two positions will almost certainly result in a loss. However, using correlations in your day trades should be done with caution. Establishing correlations where none exist is not a good idea. It is your job to simply determine whether or not there are observable correlations, what those correlations are, and how strong they are. Being avaricious. Do you remember the story about the goose that laid golden eggs? Because the goose's owner was greedy and couldn't wait for the goose to lay more eggs right away, he killed and dismembered it. Unfortunately for the owner, there were no golden eggs inside the goose because it only produced and laid one. Greed can have the same negative financial impact when it comes to day trading. Greed can cause a day trader to hold on to a profitable position for longer than necessary, resulting in smaller profits or, worse, trading losses. That is why you must be self-disciplined enough to adhere to your day trading stop loss and profit-taking limits. That is why you should program those limits into your platform as well. This reduces the chances of greed hijacking your otherwise profitable day trades. Chapter 26. Do's and Don'ts of Day Trading. Do's of Day Trading. Capital at risk. You must understand that the stock market is a highly volatile environment in which anything can happen in a matter of seconds. You must be prepared for whatever it throws at you. To prepare for it, you must use risk capital. Risk capital is money that you are willing to put at risk. You must persuade yourself that even if you lose the money you have invested, it will not be a big deal. You must use your own money for this and not borrow from anyone else, or you will feel guilty about investing it. Decide on a specific amount and invest it. Research. Before investing in the market, you must conduct extensive research. Don't expect to learn as you go. That is only possible if you understand the fundamentals. You must maintain an interest in gathering information that is critical for your investments. And this will only happen if you put in some effort. Nobody expects you to stay awake and sift through thick textbooks. All you have to do is read books and visit websites to gather enough information to get you started on the right foot. Diversification in your portfolio. You must emphasize diversification. You don't want all of your money to end up in the same place. Consider it a way to increase the potential of your stock. You must select various sectors and stocks to invest in. You should also select one of the various types of investments because they all contribute to a different outcome. Diversification is primarily viewed as a risk mitigation tool, and it is recommended that you not invest more than 5% in any one security. Stop loss. You must comprehend the significance of a stop-loss mechanism. A stop-loss strategy is used to protect an investment. Assume you invest $100 and purchase 5 shares at $5 each. To prevent the price from falling any further, set a stop-loss at around $4. You may be wondering why you need to place a stop-loss and go through with it. Well, by doing so, you will be saving a significant amount of money. You won't have to worry about the value falling further and can continue with your trade. Accept a loss. It is acceptable to suffer a loss from time to time. Consider it a small obstacle. You will have the opportunity to turn a loss into a profit. You must maintain your confidence and investment. You can lose money on a bad investment that was never going to work out. You can also take a loss on an investment that you believe will be a long-term loser for you. Taking a few losses is the only way to learn how to trade well in the market. These are the various stock market do's that will assist you with your intraday trades. Do's and don'ts of day trading. There is no preparation. Do not make the mistake of investing in the market without a strategy. You must plan out the various things you will do in the market and proceed properly. This plan should include how much you intend to invest in the market, where you intend to invest, how you intend to proceed, and so on. A lack of planning will result in a loss in the stock market, which is not a good sign for any investor. Over-reliance on the broker. You should never rely too heavily on a broker. You must make your own decisions and know what to do and when to do it. The broker will have no idea whether or not an investment is suitable for you. He is only concerned with his profits. If he recommends something, you should conduct your research before investing in the stock. The same is true for emails you may receive from certain sources. These emails are spam and are intended to deceive you. So don't fall into the trap of believing everything you read. Bulletin boards. You must be uninterested in message boards. These will be available on the internet and are primarily intended to assist people in gathering information. There will, however, be pumpers and bashers present. Pumpers will force people to buy a stock to increase its value, while bashers will force people to sell all of their stocks for the value to fall. Both of these types are risky because they will abandon the investors as soon as their goal is met. As a result, you must exercise extreme caution. Calculate incorrectly. Some people make the error of calculating incorrectly. They will be inept at math and will end up with incorrect results. This poses a risk to anyone looking to increase their wealth potential. If you are not good at calculating, download an app that will do it for you or carry a calculator with you at all times to perform the necessary calculations. The goal is to make the correct calculations and maximize your wealth potential. Copying techniques. Make the mistake of emulating someone else's strategies. You must create something that is entirely your own and not based on the work of others. If you end up borrowing, you will not be able to achieve your goals. You must sit down with your broker and devise a unique strategy that you can use to win big. Conclusion. Technical traders are day traders. They execute trades based solely on chart readings, ignoring factors such as the company's profitability, P/E ratio, debt to equity ratio, and so on. Technical charts are the only tools a day trader has for making money. Day traders typically trade in a single session and close all open trades at the end of the day, leaving no position open for the next day. Swing traders are traders who hold their position open for the next session or overnight. A day trader can trade using a variety of time frames on technical charts. These time frames can range from 1 minute or less to 5 minutes, 15 minutes, 30 minutes, 45 minutes, 1 hour, 4 hours, and even weekly and monthly. If you're wondering how a day trader can use weekly or monthly charts, you should understand the difference between time frames. Day traders choose their trading style by examining the charts and determining which time frame is best for them. Every day, many day traders can spend hours in front of their computer screens. However, many day traders trade only part-time, are preoccupied with other jobs or work, and cannot devote much time to trading every day. In such cases, these traders can examine weekly or monthly charts to determine when to buy or sell a stock. They then patiently wait for that level to arrive and trade only at that level. There are numerous ways to set an alert to notify you when a price level has been reached. The brokerage platforms provide SMS alerts to their clients about stock prices. Most charting software includes the ability to send alerts when a stock price level is reached. They save valuable time and money by trading in this manner, which they can use to pursue other money-making activities such as a regular job or doing other work. There's one more. Scalping is a highly skilled type of day trading. Because the day trader focuses on a short time frame, such as 1 minute or a few seconds, and trades for small profits, this is also known as micro trading. They keep the lot sizes large so that small profits can compound into large sums of money. Because the time frame is so short, scalpers can trade multiple times throughout the day, sometimes as many as 20 to 50 times. However, this is a risky type of trading that necessitates extremely fine trading skills. Otherwise, it is possible to lose all of one's trading money in a single session. Buying and selling on the same day is also referred to as day trading. Day traders, on the other hand, have a longer time frame for keeping their positions open than scalpers. This can take anywhere from a few minutes to several hours. The internet is rife with articles that show glamorous images of day trading, leading you to believe that you can get rich quickly using this trading method. However, this trading method necessitates hard work, knowledge, razor-sharp focus, and extreme patience, not to mention a large sum of money to invest in the early stages. When day trading, you must be completely focused. You must not allow yourself to be distracted by other things. If you can afford to have this level of discipline and dedication, you will find that day trading is a good fit for you. Day trading is also known as intraday trading. This term provides a more precise definition of a day trader because it indicates that buying and selling occur within a single day. Day traders can branch out into other types of trading, such as momentum trading, positional trading, swing trading, and long-term trading. All of these trading styles are specializations, but they do not usually fall under the day trading category.